not a big problem and they're just doing something small. I don't get it. Tom, if they've got 1.5 million people on the books, then what is 18,000?
So think of it as two ways. Amazon basically has two workforces. The blue-collar workforce that employs at the fulfillment center, they had 100,000 quiet reduction in headcount between the March quarter and June quarter of last year, as they basically didn't hire back on attrition. And then the white-collar workforce. And what we're talking about here is the white-collar workforce, 18,000 jobs instead of 10,000 jobs. And I think that is an indication of softer demand and a greater effort for cost controls. So two different labor forces at Amazon. Here we're talking more about white-collar job layoffs.
That's important clarity, Tom. So can you tell me where the other levers are and whether you think they might have to be pulled in the year ahead?
The big challenge for Amazon in the third quarter wasn't that their e-commerce was slowing. It was that their higher margin, higher growth cloud computing and advertising business were starting to feel the negative impact of a challenging macroeconomic environment. So to the extent that you continue to see more weakness, then 10,000 could become 18,000, could become 30,000. We'll see how they continue to manage costs as the demand, especially for cloud computing and advertising, remains in flux in a challenging macro.
Tom, what is Jassy going to do about the ginormous headache, the logistics of the last mile for Amazon? They got all those boxes piled up, and it just seems like getting the last mile, getting the last 4 miles, getting the last 400 yards in New York City is the ultimate battle. Are they going to fix that?
I think this is their strength. So if you look at the duopoly of FedEx and UPS, one of my favorite moments in tech was within the last 3 months when FedEx said, we're about to enter a global recession. Second statement, we're raising prices. So I see an opportunity for Amazon to use their first-party delivery efforts for all retailers. They could break the duopoly of FedEx and UPS. So I see that as actually an opportunity for Amazon. And I think that that's something that 57% of units sold in Amazon were third-party. That could grow to 75% over time.
Wow.
And leveraging their delivery effort is what will enable them to do that.
That's fascinating. Tom, thanks for the detail.
Tom
This was just
Fordy
brilliant.
classic.
A clinic from Tom Fordy of D.A. Davidson on what he thinks is going to happen with Amazon. Tom, you mentioned the analyst community on the street. The 55 buys, the 3 hold, the 1 sell. The average 12-month price target on Amazon is 135.27. Traded at 85 at a close yesterday. Tom, return potential close to 60%. Have we had the reality check here yet?
Have we had a cathartic blowout? No, I don't think we have. We have not seen nothing like a Tesla cathartic feel. That's on a logarithmic basis. Tesla's ugly. No, Amazon's just been, I don't want to own it. I don't want to own it. And with a vengeance, somebody's going to come in at some point and say, okay, they've cleared the pandemic. Let's move forward. And I go back to margin. Decide 101 at LSE, which is profitability matters. Apple has an EBITDA margin of 30-some%. Amazon has a legit EBITDA margin, unlike Walmart that's picking up pennies out in the parking lot.
You mentioned Apple. Big earnings report at the end of this month.
All of them. I am fascinated by it. I mean, Gina Martin Adams is fascinated by what we're going to see.
Have we got a problem in tech? Seems so. We've got a problem in the market over the last 12 months? Absolutely. Do we have a problem in the economy? Lisa, that's a very different question at the moment, isn't it?
Especially if labor market data comes in as strong as it has. We have that print in about 5 minutes' time in terms of initial jobless claims. It's expected to come in pretty much banging around where it has been and at historically low levels after that better than expected ADP report. So perhaps layoffs not making a dent in the overall data.
The 2-year this morning up 7 basis points now to 4.43, let's call it. In the equity market, we roll over just a touch, just a little bit. Equity futures down by 1/3 on the S&P. Jobless claims data still ahead. We'll break that down with Mike McKee, and we'll catch up with Seth Carpenter, Chief Global Economist at Morgan Stanley.
Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
So about 15 minutes ago, we had an upside surprise on the ADP report. That came in at 235. Upward revision to the previous month as well. So the jobs market data over the last 24 hours has been pretty decent. Jobless claims still to come. The estimate there, 225, the previous number, 225. When I get that number, Mike McKee is going to break that one down for you. Going into it, equity futures just a little softer, down a third of 1% with the economic data. Let's get to Mike McKee. Hey, Mike.
Hey, John, we are still waiting for that number to drop in terms of the computers, but I can tell you the trade balance comes in much lower than anticipated, 61.5 billion. It was 78.2 the prior month, and 63 billion was the forecast. And all this means is the economy is growing faster in the fourth quarter than we thought. These are November numbers, and as of yesterday, the Atlanta Fed was suggesting we were growing at a 3.9% annual rate in the fourth quarter, so significant change there. Jobless claims come in at 204,000. That is down from the initially reported 225 last week. However, I'm going to put a big caveat in front of this and note that this is the week that included New Year's holidays and Christmas holidays, and so probably this number is somewhat meaningless, and it'll be revised higher, and we'll get a bit of a snapback later. But it does show we're still in that very low jobless claims vicinity, and that is further evidence that the labor market remains healthy.
Equities roll over just a little bit more by 0.5% on the S&P 500, and yields push higher by just a little bit more. We're now up by 9 basis points on a session on a 2-year to 444, on a 10-year to 374, yields up on a 10-year by 6 basis points. Mike McKee, we've got to make sense of this. Told by all these companies that times are getting tough. They're announcing layoffs in one very specific industry I know, starting to see it elsewhere just a little bit. Then the official data, Mike. The data this morning, ADP claims, data yesterday, job openings, quits. Makes sense of it for us.
Looked at if you read through the whole minutes yesterday, the staff in particular was noting that a lot of companies were saying that it was so hard for them to find workers coming out of the pandemic recession that they're inclined to hold on to them as long as they possibly can.
Across December, I hope this number's correct. I'm working in real time off the Bloomberg like Michael McKee's a virtuoso on. 4-week smooth moving average of weekly claims, 230 down to 214 across the span of December. That's not going in a Jerome Powell way, is it?
It is not suggesting that the labor market is weakening.
Stunning. 4-week moving average, which is a way better number given the ups and downs you're talking about, with 204,000. It's just stunning.
That keeps the pressure on. I mean, they're going to be the big question tomorrow is service industry jobs. How many are created? Because that's where they're seeing the wage pressures. And so we'll go to that number first at 8:30 tomorrow morning.
Has there been any labor market data in the past couple of months that has surprised to the downside? In other words, showing a weaker than expected labor market, or has this been almost every single one coming in hotter than people expect?
Yeah, almost every single one coming in hotter than people expect. Even the numbers in terms of the JOLTS JOLTS fell a little bit only because the prior month was revised higher, and hirings did not change. They stayed at about the same level. So we're not really seeing a lot of change in the labor market at this point.
Do you want a snapshot of where the surprises have been over the last month or so? Go to ECSU on the Bloomberg if you are a subscriber. Basically, everything's surprised to the upside with the exception of one group, Tom: housing and real estate. Housing and real estate is where the downside surprises are. Mike, everything else, it's just upside.
And it's not
surprise
completely
after upside
housing because
surprise.
construction workers have been getting jobs. It's the mortgage brokers who've been losing jobs. That's
I've
the
never
big
even
issue.
looked at that screen. You're
It's
just
a very cool
font
screen.
of wisdom.
I know.
You're just a font
Been
of
here a
wisdom.
while, Tom, you know? That's where all the little
I'm learning
snapshots
every
come
day.
from. I know. Got to catch up.
Old dog, new tricks.
Mike, thank you, Mike. Coming up next hour, I'm going to run Richard Bernstein of Richard Bernstein Advisors on the equity market.
Wonderful.
Kristen
Wonderful.
Bidley of Citi, Chris Harvey of Wells Fargo,
Yeah,
and on Amazon a little bit later we'll catch up with Brent Thill of Jefferies. So great lineup.
Great
as we
lineup.
get you
Richard
to the
Bernstein
opening bell.
there on value and what it means for 2023 will be timely as well. We are honored to give you the chief global economist at Morgan Stanley. They have a heritage which is defined by Stephen Roach and others over the years. Seth Carpenter joins us this morning. Seth, I'm going to go to the Morgan Stanley way, which is you guys under Roach's leadership codified a visible argument. What is the number one thing your team is arguing about as we enter 2023?
Gosh, what sorts of things are we not arguing about? Let me say, I heard you all just before this segment talking about the ADP data and the labor market and whether or not the economy is slowing. And one place where we have tried to hold our ground, Ellen Zender, as you know, is our chief U.S. economist. She and I have been steadfast in saying we think the economy is clearly slowing, but boy, we're not calling for a recession in 2023. We're still there. I don't think we're actually in the majority with that view, but the fact that the economy is holding up is part of our view there. You mentioned the initial jobless claims data. What we're thinking is going to happen, and this is consistent with the anecdotes from the minutes, is that businesses will try to hoard labor. And so what we're likely to see is slower and slower and slower non-farm payrolls. We'll get tomorrow's data, obviously, where we're looking for about 185,000. But we're looking for a slowing down in hiring. We're not looking for a wave of layoffs.
Yeah.
Taking out that territory is going to be is where we've been.
We've alluded to the 70s. You're too young to remember the embarrassing lapels Michael McKee and I wore years ago. What actually happens to our economy, and frankly, the global economy, if we get a Neil Kashkari 5.4%, a Bullard 6.7, whatever percent? Do we all fall apart and die? I mean, we move forward, right?
I mean, I do think we move forward, but, we are looking for a soft-ish landing, if I can steal that phrase from Chair Powell. I do believe that the committee right now is feeling their way. They are close to being as restrictive as they need to be. It'll be up to the next several data points to figure out exactly when they call it quits on hiking. But then it's going to be a question for them how long to stay restrictive like that. And I think that's the part that the market really needs to internalize, is that the Fed is not trying to trash the economy now to bring inflation down next year. They're trying to slow the economy down over a multi-year process. And that really is going to be the difference, I think, between now and the 70s. And for the record, I was alive for all of the 70s.
Well, Seth, there is this issue of how much do you actually listen to what Fed officials say and do what they say versus take that as signaling that's playing some game theory to try to get the market to a place so that they can then say, look, we're all good and we don't have to raise rates as much as we previously thought. And I say this as Kansas City Fed's Esther George started talking about how she raised her forecasts for where Fed's rates will ultimately end up. This is kind of what Neil Kashkari was talking about a bit yesterday. Does that guide you in any capacity? Do you trust them or do you push back against them with the rest of the market?
So I trust them in the following sense. They are talking about what they think they would do based on the availability of information right now. And so then what we have to do is overlay what we think is actually going to happen with the actual data, what's going to happen with jobs, what's going to happen with inflation. And if inflation keeps coming off, as it has been, and if job creation continues to slow, then I think what they're going to say is, wow, we have got the traction that that we wanted from restrictive policy, and we're seeing the slowing that we want, so we'll be able to step back. So I don't think they're going to get to the heights with the funds rate that some of the members of the committee have pointed to, because I think the data will slow enough to give the core of the committee that sort of comfort that they can stop.
The problem is that the data on the goods inflation has slowed, that you are seeing some disinflation there, but you're not seeing that in jobs. And this is where let's really end where we began here. This is the big dilemma. Will the Fed keep hiking rates in the face of strong labor market data, even if there are signs of disinflation elsewhere?
Yeah, I think if it is continued very strong labor market, then I think they keep going. You know, we're looking for another step down tomorrow, 185. The ADP data came in. I tend not to look at their numbers, but I do spend time looking at the commentary that comes through, and they are pointing to a little bit of easing of wage pressures as well. So I do think we are seeing signs that we're going in the right direction, that things are slowing, but there's no sense in which right now things are weak. If we went back up to 300,000 jobs per month and stayed there, then there's no question they keep hiking.
Before we let you go, Seth, I want to mark a funeral for negative yielding debt. It is gone. It is dead. It is over. The last negative yielding coupon has gone. Will the consequences of the end of the negative yielding era be borne out over the next decade, over the next year, or have we already seen it in what we experienced last year?
Oh, I think there's any number of repercussions to come. And if we're right and the Fed is able to stick with their strategy of not just hiking until they're restricted, but staying there for at least the balance of this year, then those higher rates are going to have an effect for some time to come. I think the other interesting question that will come up and will be a topic of discussion is going to be one of fiscal sustainability, because as those interest rates go higher and governments have increased their debt, the total interest payment that they're making is going to have to go up as well.
Seth, be nice to Ellen Zentner. You know, New Year's resolution. Don't be so argumentative like Steve Roach was years ago. Seth Carpenter of the fractious Morgan Stanley team as well. This is a joy and an honor with the Michael McKee as well. Yesterday was the 30th anniversary of Bloomberg Television and Bloomberg Radio. This goes way, way back. McKee is one of the few that can reach back into the medieval epic, as they say, of how we started out. And for those of you on radio, we're showing, thank you, Catherine Oliver, a Bloomberg Radio, the single best promotion we've ever done. It had one radio station.
One radio station.
One radio station.
I've still got mine somewhere.
In the acclaimed Bloomberg keyboard. This was started, folks, with obviously the inspiration of Michael Bloomberg, who said, can we do this by January 1st? And of course, everyone said no, but the Bloomberg way, Michael McKee, is of course we can. And we need to say thank you to Frank Trainer, who was the first guy I ever talked to here at Bloomberg, and KO, Catherine Oliver, and a guy named Charlie Pellet and John Tucker. They were there at the beginning.
They were there, and Charlie and John are beavering away in the back today as they continue their service to the company.
The reach that we did, I think that is so important. Very quickly here, Mike, it was the global reach that Mike demanded. Others went more domestic, more narrow. And from day one, we said global radio, global TV.
It's been a hallmark of the whole company. It's global. We focus on the news that people need wherever they are.
And one thing that's so important here is we've gotten the Fed call wrong for 30 years.
Yeah, but we're in good company with that.
Well, congratulations to all, and particularly to Catherine Oliver and the founders of Bloomberg Radio and TV. 30 years on for this institution. We are going to continue. Futures deteriorate -20 off of that shocking set of economic statistics. 10-year yield out 9 basis points. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's another round of votes on the speakership. Today, lawmakers will meet again after Kevin McCarthy failed for a 6th time in his bid to be elected to lead the House. The California Republicans said a lot of progress was made, but still, hardline conservatives didn't make it easy, and there was no resolution to the standoff. Strikes on the British rail network reach a critical peak today. Some of London's biggest rail stations will be closed, while some airports will also be deprived of train service. Train drivers, represented by the ASLEF union, are walking out following a long dispute over pay. Turkey's President Recep Tayyip Erdogan has urged Vladimir Putin to declare a unilateral ceasefire in Ukraine. The two spoke on the phone today. Erdogan says that a ceasefire could be accompanied by a vision for a fair solution. Turkey has pitched itself as a mediator in the war. Shares of Bed Bath & Beyond are plunging today. The chain warns that there is substantial doubt about its ability to continue as a going concern. Bed Bath & Beyond says it's considering all strategic alternatives, including obtaining relief under the bankruptcy code. And Bloomberg's learned that First Abu Dhabi Bank has been exploring a bid for London-based Standard Chartered. It would be a complex deal aimed at building an emerging markets lender with more than $1 trillion in assets. Shares of Standard Chartered are soaring. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Business leaders, certainly at the moment, they say that what the headwinds that they're facing now is almost more challenging than it was in the height of the pandemic. Lots of input costs coming in, higher prices for businesses themselves, which means that some of those are feeding through into the prices that consumers are paying. There's a really tight labour market. Supply chains are a little bit easier and more straightforward than they were in the early part of last year, but freight costs are still much higher than they were pre-pandemic.
Helen Dickinson, the British view there on the challenge of retail going forward. This is great, and Lisa and I can do this. We are so thrilled to bring you John J. Edwards III, who is an extinguished member of luxury journalism. And this goes to Fargo. In your days in Fargo, if you go to the Wall Street Journal mansion section, down near Rapid City, there's a guy who won the Powerball who's trying to sell his 50,000-acre ranch for $37 million.
Okay, well, what's he going to furnish it with?
What's he going to furnish? He's got to go to Bed Bath & Beyond.
How many towels can he get, and of what tenors and colors?
14 bathrooms, 15 to the guy. It's his fault, folks. We all do this. It's like, it's like porn for older people. It's John J. Edwards' fault that we have the Wall Street Journal Mansion Edition. What's it like doing the Mansion Edition, launching it, and doing it as you and your team did?
Well, it was a lot of fun, actually.
Did you know it would be as successful as it is?
I think, it seemed like a good idea at the time. It seemed like, it was a good fit for our readership, very interested in high-end luxury real estate.
Way successful. Let's bring it over to the latest crisis, which is Bed Bath & Beyond. Those people aren't going into Bed Bath & Beyond. Nobody else is as well.
That's the
Why?
problem. Well, they've had a lot of execution problems on top of the issues that are afflicting retailers in general. So they've had just multiple quarters of negative growth. They have been really struggling with their merchandise mix, and now it's been cascading for some time. We've been reporting that suppliers have been holding off on giving them product because they're concerned that they're not going to be around forever. They're not going to get paid, and as we see today, they issued a going concern warning. So they're worried they might not stay in business.
I'm going to piggyback on something that Tom has been talking about a lot.
Mm-hmm.
Why has Bed Bath & Beyond existed in the form that it's been in for so long, given all of the distress that people knew about and people were penalizing it for? In other words, is this going to be the first of the zombie roll-up?
Yeah, that's a good question. I mean, it's a lot of the problem has been their private label strategy. They bet big, starting several years ago on designing more of their own products. Ideally, if that works, you get higher margins because you're not paying outside suppliers for things. The problem is that they just executed it extremely poorly under 2 consecutive CEOs.
I guess the other way of asking this is, you get a lot of chances when money's free. People can keep giving you a lifeline to keep going at it. Is this basically the beginning of the end of some of these sort of companies that have been struggling for a really long time? I think of Sears and how long that whole debacle took to play out. You think about some of the real laggards. Is this basically where the music stops and suddenly they have to justify performance and not just the dream?
Yeah, no, absolutely. And I think, it's going to be hard to see, what ends up happening out of Bed Bath & Beyond. They very well might end up just being one of those names that, we... think back years from now. Oh, we remember they existed once. Yeah.
On the radio, they're putting up a chart of Bed Bath & Beyond on TV. It spells zombie. Okay, it's not us to badmouth companies. I don't want to go there. Other than, as Lisa mentions, their track record, total return is bleak as well. I'm going to go to the Bloomberg, as John J. Edwards III can do, and look at the weighted average cost of capital. These clowns have 81% debt, and they're not a bank. They have 81% debt with a blended cost of 5.3%, which Bramwell will tell me is ginormous. It's just simply what Lisa said. Now money isn't free. Were they kept alive for 10 painful years because money costs nothing?
I think that's got to be a big part of it. Yeah, I mean, they were able to sort of skate along. They had sort of multiple, recovery plans, and then they changed their management. They went with Mark Tritton from Target, who had success with private label there, but he, sort of tried to play too much of the Target playbook.
Did Amazon ruin them? I mean, I was in there the other day looking at the Everyman Mauve Glow towel. They were out of it. I wanted the pink, the Mauve Glow towel at $22. We're going to get 5 or 6 of them for the 4th bathroom.
Sure.
Vet bill wanted, the dog wanted the towels. They didn't have the towels out. But come on, the people that are at Bed Bath & Beyond, they're walking over, they're watching the show, thank you, and they're clicking on Amazon on their phone going, I want those mauve towels.
Yeah.
Did Amazon kill Bed Bath & Beyond?
I mean, it certainly didn't help, right? I mean, and I think that's where you get into, they faced a lot of the issues that other retailers faced. Everybody's been competing with Amazon and Walmart and has been struggling to greater or lesser extent, but there were specific execution problems at Bed Bath & Beyond that made it even worse.
Did you ever go visit any of those mansions at the Wall Street Journal? Did you actually go out? Did you ever go visit any of those mansions at the Wall Street Journal? Did you actually go out there and see one of those monstrosities?
I personally did not visit any of the ones that we ran. No.
These things are like 15,000 square feet.
I can tell where your head is, Tom. I mean, you're just saying, should I go with you?
You look at them and you go, really?
Okay, well, let's go back.
This is John Edwards' fault.
I want to go back to something that you said, Tom, and I thought it was a really stellar point, which
I did
is,
okay?
you did great. The Bed Bath & Beyond, was this a company kept alive by free money? And it raises another question on top of that, which is, how many more Bed Bath & Beyonds are they? how much is this going to become a common story versus the idiosyncratic tale of a company with execution issues?
Yeah, well said. What's it mean for retail?
Yeah,
Seriously.
I mean, I don't want to name any other
No, it's not
companies.
appropriate. No, you can't. You can't. There's very serious. There's very serious laws on this.
Yeah.
Don't mention the names.
No,
but there's like mid-level department stores get killed.
Yeah.
Is it the teenage stuff? What gets killed here?
Yeah, I mean, I think that mid-level area where it's difficult to see what their appeal is overall. They're not high-end enough for the high-end. They're not low-end enough for people who are looking for true bargains. They're going to struggle. I think everybody likes to see a nice sort of transition from calendar year to calendar year, but as bad as 2022 was for a lot of these retailers, 2023 is not looking all that much better. A lot of these issues are still out there. The high inventories, that they have to work through. So yeah, it's going to be a struggle, especially with money not being free.
By the way, I love that as you talk about this, and I'm very interested. Tom is looking at mansions over here. I guarantee you, he's looking at the mansion tour and trying to come up with something to ask you about for his next purchase.
No, come on. This is Beaver Creek out in Colorado. This says you.
Yeah.
Ski in, ski out, $22 million. That says you.
Oh, yeah, you want to buy that? Go ahead. I love that. Thank you. No, honestly, I could just guarantee that. I nailed that one.
10,500 square feet.
Exactly.
For a ski home.
I know. Well, it's for a select crowd.
But as you said, none of those people are going to be shopping at Bed Bath & Beyond.
Hold on a second, but there is another question to this, which is how many of the retailers that really are struggling still have real estate, and how much is that going to be helpful versus hurtful?
Well, it's better than not having it, but it's a lot of these companies have had have had real estate for a long time, and it hasn't been the panacea that people have thought. I think it can be hard to repurpose a lot of these retail facilities. Certainly ones that are connected to malls. If you sell the part that they own, it's still connected to a mall that's probably failing.
15 seconds. Your team leads on this. What do all these empty stores in America do?
What do they do? I mean, a lot of them are working to sort of repurpose, go to entertainment uses, experience, that kind of thing. There's need for more residential conversions. So
you think we're going to see residential conversions?
Yeah, we're going to see more of them. Yeah,
we're out of time. John J. Edwards III with us here with his true expertise on real estate. We'll have him on much more here through the year as well. That was I learned about. I mean, I never got Bed Bath & Beyond, but fine.
Well, I think a lot of other people clearly didn't.
Faro has the whole thing right. You walk in and the inventory is overwhelming.
Well, it's just hard to find what you want in an era of internet sales. It seems like, why bother? I do think, though, I'm still thinking about the idea of repurposing some of these spaces. You asked this question.
Huge story.
And, what do we get? A lot of axe throwing or, escape rooms? I mean, water parks? I'm just wondering what experiences have lasting power in some kind of capacity.
Last time I walked into Bed Bath & Beyond was to get a shower curtain. Nixon was president. So
how's the shower curtain holding up?
I haven't changed it since then.
Yeah, exactly.
That's why they're hurting.
Is it brown?
It's brown. Oh, we won't go there. Futures deteriorate, -21. Dow futures for John Farrell, -166. The VIX expands out a little bit, 22.46. Tomorrow, join us for Jobs Day. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is Bloomberg.
The tech companies are indicating the labour market is weak, and then the labour market data is indicating the labour market is strong. Which one is it? We'll discuss. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Here comes the pain. Amazon confirming plans to lay off 18,000. Fed officials delivering a blunt warning, keeping big tech in the penalty box.
Tech's going to take time. Tech had this massive labor boom. It's starting to come off the boil. We're seeing layoffs in tech.
Tech companies cutting costs.
They're not good cost cutters traditionally, right? They're growth companies.
He's probably right that they're not used to doing that.
And so they're going to be late on that.
Earnings are likely to come down another 15% from where consensus is right now.
There's a shooter drop on tech earnings. And we've started to see that.
What's risky is that investors are still hugging a lot of those secular growth, long duration areas of the market.
Valuations have been absolutely crushed.
That area of the market is still relatively crowded.
We forget how cyclical some of these tech stocks are.
We're still underweight tech. We're still underweight communication services.
Joining us now to discuss this RB's Richard Bernstein and Chris Harvey of Wells Fargo. Gents, fantastic to catch up with the both of you. Wanted to go to these two quotes from two tech chiefs and really compare and contrast what they're saying with what we're seeing in the data. This was from Mark Benioff of Salesforce just yesterday. As our revenue accelerated through the pandemic, we hired too many people leading into this economic downturn we're now facing. Andy Jassy of Amazon, after announcing plans to lay off 18,000. This year's review has been more difficult given the uncertain economy and that we've hired rapidly over the last several years. Now, when I look at the economic data is really strong. When I hear from these tech CEOs, things look painful. Rich, when you look at things, which one is it? Do we have a strong labor market or signs of a weak one?
Well, John, you kind of have both. You have a very strong labor market. I mean, even the numbers this morning that came out, show a labor market that's not white hot anymore, but probably still red hot or hot to the touch. And at the same time, you've got the tech sector, which is in contracting mode, right? I mean, this was a sector that was in full-fledged bubble mode for a couple of years. They hired indiscriminately, And now they're feeling the downward pressure on that. And so the interesting thing is so far, and I think the key word is so far those laid off workers are getting absorbed into the economy. We'll see how long that lasts, how many layoffs they have in the tech sector and how many hires there still are in the rest of the economy. But so far, those workers are being absorbed.
Rich, you and I have talked about the excess in this particular specific industry. Chris Harvey, I'd like your view on this. When we talk about excess in tech, sometimes we talk about the last 2 years, sometimes we talk about the last decade. When you think about unwinding excess in this industry group at the moment, Chris, are you thinking about the excess of the last 2 years or maybe the last decade?
John, I'm really talking more about the last 2 years or last 2 or 3 years, right? You have what's happened is people took a rule and they extrapolated out. They thought, oh, these COVID trends, this is a once in a lifetime issue. This is a secular issue. Everyone's going to be buying online. And so as a result, we got higher. And that's just not true. There is cyclicality in tech. We're finding that out. They overhired. In addition to that, we had an interest rate environment that was exceptionally low that let a lot of companies in that shouldn't have been let in. And now what we're doing is we're going back and the strong will survive and the weak will not. And what we're seeing is very similar to what we saw with energy several years ago. Investors are now saying to the tech space, enough with the growth, show us profitability. If you can show us profitability in your younger company, we can give you money, we can invest in you. If not, then good luck to you. And that's one of the things that's going on is people are now rationalizing things because the cost of capital is much different as we go forward in time.
Rich, do you agree?
Yeah, I think Chris said something at the very end there, which is really important about the cost of capital, that when interest rates were zero or near zero for an extended period of time, the hurdle rate, which is the rate that investors have to consider in making rational decisions, when the hurdle rate is 5%, you have to say, well, I want to get 5% or more out of my investment. When it's 2%, you say, I want 2%. When it's zero, you invest in every silly opportunity out there because you're sure you're going to get more than zero. As the Fed has started to raise rates, you've seen all these silly investments, whether it's cryptocurrencies, whether it's tech companies that are way too young to come public, all these kinds of silly things have started to underperform very dramatically. And so Chris's point about the cost of capital is exactly what your finance textbook says should be going on, and it is going on.
So, Richard, we've got to work out if this is a moment in time or a new regime. And I know from speaking to you over the last couple of years, you think this really is a new regime. Are you finding that clients are more convinced by that or still holding on to this idea we can go back to the pre-pandemic themes?
Right. Well, I think our investors are pretty much engaged with us, and they agree with us on that. But I don't think that's true in the consensus. I think that there's still way too much talk about will the old leadership regain form, right? In other words, should you look at this as a buying opportunity in this old speculative leadership? I think that's a very bad sign because it shows that there still hasn't been full capitulation yet in these sectors of the economy. Meanwhile, other sectors of the economy are experiencing, significant outperformance relative to the overall market, and like nobody cares. You're not finding people talking about why aren't we looking at the opportunities in consumer staples or healthcare or utilities or all these traditional defensive sectors that are actually performing quite well. No, they're still focused on tech and communications and consumer discretionary.
They were the winners of last year, so Chris, let's frame it that way. Do you think old leadership regains outperformance, or do the winners of last year maintain momentum?
John, let me take a step back and look at it this way. So what's happened is you've taken speculation out of the marketplace, and you should have taken speculation out of the marketplace. Because again, what you've done is you've brought real rates from negative to positive, and now those economic models don't make sense. The second thing is what you pay for something means something, right? If you're looking at companies that are 10, 20 times revenue, not earnings, those days are over, right? If you're looking at growth companies that are trading at a reasonable market-like multiple, maybe a little bit of a discount, maybe a little bit of a premium, yeah, those growth names can work. So really what it's about, it's much more idiosyncratic. I think it's much more about what you pay. And now what's going to work going forward, we think that the sweet spot in the equity market is mid-cap growth, because we're going back into a growth market as we think inflation comes down, growth comes down, and eventually rates come down. But that doesn't mean that you're going to have the high flyers come back in the marketplace. What you pay for something is exceptionally important, and you can find good valuations, 14, 15 times earnings in mid-cap growth.
Richard, your response?
Yeah, I would go even a step further. I think the definition of growth is actually changing. I think the global economy is changing, and I think the old leadership was geared to a secular disinflation, lower interest rate type environment. I think that secular period is over, and the next 10 to 15 years are going to look very different. So I think the whole definition of growth has to start changing. There's actually data to support this. If you look at analysts' bottom-up growth estimates for the next 5 years for earnings, you will find the number one sector for growth is energy, and the number two sector is industrials. And both sectors have substantially higher growth rates than either technology or communications or consumer discretionary. So I think we're in a metamorphosis period here where the definition of growth is actually changing.
Richard, given what you've just said, how challenged is the index story, the S&P 500, through this year and maybe beyond?
Oh, Jonathan, great question, because I think that we all know that the U.S. equity market is dominated by the three sectors that I've been harping on in terms of technology, consumer discretionary, communications. I think it's still about 40% of the S&P 500, take or leave a little bit on that. They dominate the index. I think that's a huge story because the opportunities are in basically everything else, and the opportunities are outside the United States, right? I mean, I don't think people realize that 70% of non-U.S. markets outperformed the U.S. last year in U.S. dollar terms. And that's largely because of the domination in the United States of those three sectors that were so overvalued and have been underperforming so dramatically.
Chris Harvey, are you on the same page?
John, what I would say is we recommend small caps. We recommend mid caps. We think they're going to outperform. So it's not that different than what Rich is saying. And one of the reasons why international has performed so much better is because of the lack of tech in many of those markets. And then the last thing I would just say is last year, it was really what you avoided that helped you out the most. So if you avoided tech, you did okay. Not great, but you did okay. And that's what a lot of these markets are doing. The last thing I would say is back to Rich's point about where the new growth is. If you look at mid-cap growth, one of the biggest sectors in mid-cap growth is industrials.
Absolutely.
The other big challenge here is the Federal Reserve. The latest minutes, we were pouring through that just yesterday, and I think this is the quote that jumped out for many of you. An unwarranted easing of financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. Might be key. This Fed is signaling there might be more pain to come.
Yeah, John, the thing about the minutes is you can't make things up, but what you highlight in the minutes can put emphasis on something, allow you to spin. We knew from their economic projections, the dot plot, Jay Powell's news conference, that the Fed was going to keep raising rates and keep them high. I think the minutes are essentially an effort to, as I put it, whack the markets upside the head and tell them pay attention, because inflation, they highlighted, unacceptably high, suggesting more rate hikes to come. No participants anticipated rate cuts in 2023. Nobody's cutting rates. And as you mentioned, the unwarranted financial conditions easing complicates their job. Now, you can see what the issue is that they keep talking about. When you look at this chart here, it shows you what the CPI, less housing, the services part is, and what that compares to in terms of wages. And both are well above the channel that is a sustainable wage pace. Those have to come down, and we're not anywhere near that 2% growth figure. So that's what the Fed is looking at and why they're drawing these conclusions, and it's what we're going to be looking at tomorrow. We got some numbers today, of course, that sort of underscore the fight for the Fed ahead. ADP, 235,000, and it's worth mentioning the last 5 months, they've undershot what non-farm payrolls are. They're over what non-farm payrolls are. Jobless claims really low. So we still have a forecast of 200,000 and a 5% average annual pay gain there, and that would be above that channel. So the Fed's going to do more work, and they want you guys to know that and react appropriately.
You guys being the people in the market, Mike, thank you, buddy. As always, looking forward to your coverage of the data out a little bit later this hour and this morning. So Morgan Stanley's Ellen Zentner had this to say about the minutes. Off the back of those minutes, she said this: financial conditions are too easy, reflecting a misperception amongst investors of the Fed's reaction function. As long as financial conditions are misaligned with the Fed's goals, expect additional tightening. Chris, I want to come to you on that. That line from Morgan Stanley and that line also that's within the minutes, a misperception among investors of the Fed's reaction function. How do you respond to that?
I respond to that in a couple of different ways. One, the Fed does want inflation to go down, and they want inflation to go down sooner rather than later. And they want financial conditions, and I think financial conditions need to be tighter in order for that to occur. And again, it gets back to the cost of capital. Part of financial conditions is the cost of capital, credit spreads, and so on and so forth. And when you make it tighter, then loans start to slow down, the economy starts to slow down, and ultimately what they want, they've been very, very clear. It's about jobs and wage inflation. And in order to get to their goals, they need to slow down the economy because demand is too strong for the labor market at the present point in time. And they've said very, very loudly that they need to slow down the economy for a sustained period of time. And so as a result, they need tighter financial conditions.
Richard, your thoughts?
I think, Jonathan, that, the Fed, I think people who are thinking about a Fed reaction function are looking at data that really isn't applicable to what the environment that we're in right now. And what I mean by that is that when we were in a period of secular disinflation, there was a Fed put, right? The Fed could ride in on the white horse and save the day because we were in a period of secular disinflation. And the disinflation got so embedded in the economy that the Fed even started taking their eye off the ball, right? How many people were complaining that the Fed was talking about climate change and all these other things? Yep. Well, you're not hearing the Fed talk about climate change today because inflation is much higher, 40-year high. Their eye is on the ball. They have one mission. So to look at the Fed's reaction function over the last 10 or 15, maybe even 20 years is worthless in the current environment. And I think we have to all understand that the whole credibility of central banking is on the line here. The Fed is going to err on the side of being tighter rather than looser because they don't, Fed Chair Powell doesn't want to go down in history as being the Fed chair who ruined secular disinflation. I think we should think of the Fed as being very tight for an extended period of time.
You can see they are conditioned by the 1970s and the experience then. You can see the weight of that is something that they carry. And I think we heard that from Neil Kashkari from the Minneapolis Fed. What I hear from you, though, Rich, just going through your calls, you don't think we go back to the pre-pandemic regime. You think the index level is challenged. You don't think this is a moment in time. You think this is a new regime. And Rich, underlying that really must be a call that you don't think that the Fed funds rate, even if it peaks at 5, is returning to what, 3, 2, anytime soon?
Jonathan, I wish I knew. I have no idea. I'm kind of the worst forecaster for decimal points that you'll ever find. But I think we should think of the Fed as being tighter for longer than people think. However one wants to interpret that, I think is fine. But I think the notion that somehow the Fed is going to revert back to a pre-pandemic Fed mindset, I just think that's 100% wrong. I think we're in a new era. Now, I do want to point out that I think that that's the reason you're seeing volatility, by the way, is that we are entering a new era, and the old leadership was geared for the old version of the economy. New leadership is emerging now, and I think that if there's plenty of opportunities out there, I just don't think people want to even consider them.
So let's finish on the earnings call as well. So next week we get CPI. After that, we get earnings from JP Morgan. And Chris, if we can finish there, that would be great. Do you think we're overestimating revenue growth this year or underestimating margin pressure?
I think we might be underestimating margin pressure. Right? Margins have held up exceptionally well up until this point. We are beginning to see that margin pressure. We're beginning to see volume go down, and we're beginning to see the consumer become exhausted. What the consumer has done over the last several years or since the pandemic is they've gorged on goods, housing, goods, auto, so on and so forth. They've drawn down savings. They're still in a decent spot, but they're now much more concerned about what they pay for things. Before, there was no price that was too high. Now, price is a concern as people start to look at their finances and say, things are a little bit tighter. We're a little bit more concerned about the economy. So as a result, where we think the pain is going to be on the good side, but it's also going to be on the margin side, and we think margins are going to be challenged, which makes it a very difficult environment for earnings. We expect earnings to be more challenged this year as well.
Richard, final word?
Yeah, I think Chris nailed it there. The way I would describe it succinctly would be to say that on the consumer side, one should emphasize necessities, not desires, right? That if margins are going to be squeezed, necessities are going to hold up. No matter what goes on, we all still eat. That's really the story.
Richard Bernstein, Chris Harvey, to the two of you. Fantastic conversation. Thank you. Coming up on this program, the fight for Speaker continues on the Hill.
It's not a good look. It's not a good thing. It's the United States of America, and I hope they get their act together.
Kevin McCarthy gearing up for round 7. Anne-Marie down in Washington, D.C. up next.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
City.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Regard to the fight over the speaker. Excuse me. That's not my problem. I just think it's a little embarrassing it's taking so long in the way they're doing with one another. And the rest of the world's looking. It's not a good look. It's not a good thing. It's the United States of America, and I hope they get their act together.
House Leader Kevin McCarthy's bid for Speaker remains elusive. The stalemate now rolling in to a third day following 6 rounds of voting.
What is the strategy going forward with McCarthy?
Work through it, get everybody together, and solve the problem.
Are you so confident that you can pull this out? 6 failed votes?
Yeah, very.
The House scheduled to reconvene at 12 p.m. Eastern Time. Let's get to AMH down in Washington. Anne-Marie, walk me through what today looks like.
Well, today, really, the question is, has Kevin McCarthy made any progress? And the reporting is, Jonathan, that he has really given up a number of concessions to this group of 20 dissidents in his party. The biggest really being this motion to vacate, allowing one single individual to call for a snap vote of confidence. So the two big things, if Kevin McCarthy, what to watch out for is, one, did he make some progress bringing those numbers down? He needs, obviously, 218. But if he does get to the speakership, his position will be incredibly weakened because of all these concessions he gave. The other thing to watch out for is the fact that as he's giving up so much, at what point does the other wing of his party, right, the centrists and the moderates, say enough is enough, and then they start to rebel? It's a very tricky tightrope he is walking right now.
So, Anne-Marie, are we saying it's messy if it continues, and it's messy if he actually becomes the speaker?
Yes, exactly. Messy, really, for whoever becomes speaker, because the Republicans have just a slim majority, and they have a growing Freedom Caucus that is demanding so much more. We saw this in 2015. We even saw this more so. It really started in 2011, but it is growing to a point that it's very difficult for an individual to govern. And the Democrats are really sitting back and watching this and enjoying this and making sure that they are going to hold their line to not give the Republicans any inch to make this easier.
Mate, I've got about 20 seconds with you. Can you talk to me about alternatives? And are the Republicans that are voting against McCarthy, are they presenting any?
Well, there's obviously a few names being thrown around. Steve Scalise, who is McCarthy's number 2, is one of those individuals. Does the math add up for him? Potentially it could for some of these never Kevins, the likes of Lauren Boebert, the likes of Matt Gaetz, who say they will never vote for Kevin McCarthy, and it's become a little bit more personal. Then there's these dark horse candidates, Jonathan, like Patrick McHenry. But these individuals at the moment are saying they do not want to touch this gavel, and they are really throwing their support to McCarthy.
The drama continues down in D.C. Anne-Marie, I know you'll be on top of the story through today for us on Bloomberg TV and on Bloomberg Radio. 7 minutes away from the opening bell, futures down 0.8%. Coming up, the morning calls, and later, Morgan Stanley's Mike Wilson warning about a nasty earnings recession. More on that with Citi's Kristen Bidley around the opening bell.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equities down, let's get you some morning calls. First up, Bank of America, downgrading LA Financial to underperform, cutting shares by 2 notches with rising rates, softening demand for loans. Piper Sandler downgrading Nordstrom to neutral, expecting a volatile environment to weigh on the consumer. And finally, Jefferies upgrading Oracle to buy. Analyst Brent Thill expecting software stocks to outperform in the second half of the year. That stock is up by 0.4%. Up next, more behind the man with the call. The Jefferies analyst Brent Thill on the growing list of big tech layoffs, plus Citi's Kristen Bidley making the case for defense in 2023.
activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
23 seconds away from the opening bow this morning. Good morning to you all. Equity futures lower by 0.6%. The labour market data is still okay going into payrolls tomorrow. Nasdaq futures down by 0.75%. Equities down. Guess where yields are? They're pushing higher. There's the opening bow. Take a look at the bond market now. On a 10-year, yields up through most of this morning. Up 8 basis points now on a 10-year to 376.69. Up more so on a 2-year yield. In the FX market, dollar strength off the back of that. Euro dollar 105.50. We're negative 0.5% there. And starting 23 with a bang in the commodity market. WTI down by more than 9% or so in the crude market over the last couple of days. This morning trying to bounce and just about holding on, up 0.4% on WTI, $73.13. About 20 seconds into the session, we're down 0.5% on the S&P. On the Nasdaq, we're down 0.7%. One stock to watch at the open, you know the name, it's Amazon. The tech giant laying off more than 18,000 jobs. The CEO, Andy Jassy, writing in a memo to staff, this year's review has been more difficult given the uncertain economy and that we've hired rapidly over the last several years. Abby has more. Hey, Abby.
Hey, John. Well, one question that is really developing here, I suppose that there are a couple of questions, one of them being what you were talking about before with Richard Bernstein and Chris Harvey, the idea of the strength, the continued strength, solid job market, but with this weakness in tech. But another one is, how do we have some of the world's best management teams having overhired so much? Because, of course, Salesforce yesterday said the same thing, similar to Andy Jassy, talking about the difficult environment, but really that overhiring. It seems as though the Fed liquidity excess ballooned right into some of the best tech management views, that excess, huge growth in hiring, and now Amazon joins the increasing pool of these tech companies cutting 18,000 workers, as you just mentioned, out of jobs from Amazon soon. And they seem to be at the higher level, the corporate level, so probably to help the profit margin. Now, interest rates at 0%, as you were talking about, again, with Richard Bernstein and Chris Harvey in that great conversation. The cost of capital, it seems as though it's even given management teams the idea that there's not so much risk out there. And there's that expansion in the job growth for Amazon over the last roughly 10 years now starting to stabilize. The question is, how much does it come in on those quote-unquote silly investments that 0% can allow for? We will find out as the future goes on, but it's not just online, internet, pandemic thinking. Take a look at the fact that it's also Salesforce, which that's enterprise software, Uber, and even Cisco, the old school tech company, John, cutting jobs right across. So let's see who else joins this list at this point, but lots of interesting questions arising from this dynamic.
Abby, thank you. That stock is down 0.6%. We'll continue this conversation coming up shortly. Brent Thill of Jefferies, don't miss that in about 10 minutes from now. Retail really feeling the pain. Bed Bath & Beyond coming out with a bankruptcy warning this morning. The stock's down 22%. The stock plunging as the company's recurring losses and negative cash flow cast doubt over its ability to continue. Kaylee has more. Hi, Kaylee.
Hey, John. Yeah, this is absolutely brutal for Bed Bath & Beyond. The actual quote from the statement is that there is substantial doubt of its ability to continue as a going concern. So it is considering a number of options here, including potential asset sales, debt restructuring, reducing business, and yes, ultimately even filing for bankruptcy. But another quote, they said these measures may not be successful. So that is why you are seeing the stock punished so brutally this morning. And of course, Bed Bath & Beyond has been having difficulty with its fundamental business for some time. It has seen 5 consecutive quarters of declining sales growth to the tune of 20% or more. And in all but 6 of the last 28 quarters, same-store sales have deteriorated. They have had a difficult time turning things around. They brought in a new CEO, Sue Gov, after Mark Triton departed, and they're attempting a strategic shift away from some of its private label lines toward national brands. But the problem is a lot of those brands who they want product from actually weren't even willing to supply them because they were so concerned about the financial health of this company and their ability to get paid. Plus the fact that the debt has been trading at distress levels for some time, pretty foreboding signs for this retailer. And all of this is made more interesting, John, by the fact that this was a retail favorite stock, retail traders, that is, a big part of the meme stock boom 2 years ago. At its high in January 2021, it was trading north of $50 a share. This morning, it is south of $2 a share. So this is just a stunning example of the fact that the era of free money is over. The fundamentals matter once again, and the fundamentals for this company, John, are not looking good.
Brutal, ugly. Stock's down 23%. Kaylee, great work as always. Biggest one-day drop going all the way back to August. That just gives you an idea of how tough things have been for this name over the last couple of years or so. Looking ahead to earnings season, really kicking off next Friday with JP Morgan. Morgan Stanley's Mike Wilson painting a very ugly picture.
We're going to get a nasty earnings recession. And so the companies that can deliver on the cost efficiency are the ones that are going to continue to perform until you fully price, whatever this downturn on earnings are going to be.
Citi's Kristen Biddley looking for a double-digit downside. She writes the following: corporate earnings are likely to fall 10%. We have not yet seen the impact of the financial tightening on earnings. We will see that in 23. I'm really pleased to say that Kristen joins us right now. Kristen, is it too early to expect to hear those kind of things from some big names from the S&P 500 in the next couple of weeks?
I don't think it's too early. I think we're going to see the start of it within Q4 earnings, and that's going to be a theme throughout 2023. This shift from what was 2022, focusing on inflationary pressures, those companies with durable demand, to being able to pass this through to consumers, to now all of a sudden looking at the impact on growth. And so in 2022, we really only saw maybe 2 sectors focus on this. It was financials, who talked about loan loss reserves, growing credit card balances, and the retailers. And I think this is going to start to spill into other sectors, which is why we're calling for an earnings contraction of upwards of about 10%.
So what I also hear from you then, Kristen, is you don't think we've seen the lows in this equity market over the last 12 months?
Unfortunately, if you're in the camp that we're going to see a recession, equity markets have never bottomed before a recession has officially begun. We've never seen that throughout history. And so that is something to keep in mind. The other thing, too, is when we talk about what's being priced into markets, I know we're talking about 2022 being an awful year with the S&P 500 being down over 18%. But if we look at the trend over the past 3 years, the S&P 500 was up over 30% in 2019. It was up 18% in 2020 and nearly 30% in 2021. So some of this is mean reversion in terms of the exogenous behavior that we saw in supply chain shocks, in COVID. And so a true recession and a true earnings contraction is not priced in here.
So, Kristen, Richard Bernstein was on the program a little bit earlier from RB Advisors in the last 30 minutes or so. And he thinks this index story on the S&P 500 is going to be challenged for quite a while because of the weighting to growth companies, the weightings to these big mega cap tech companies. Do you agree with that then?
I would agree with that. I think the challenge that we have is, we always say don't fight the Fed when there are easy monetary conditions. We have to follow that sage advice when there's tightening financial conditions. All of the data that we're getting, whether it's the commentary out of the Fed or the data around the the jobs and employment picture is telling us that they're going to continue on this tightening path. And so ultimately, I think that is something that we don't want to be in a position where we're investing in companies that are reliant upon very low interest rate environment or don't have the balance sheet or experience or leadership to be able to navigate these tighter financial conditions, which we expect for quite some time.
Well, let's talk about leadership decisions right now. Mark Benioff over at Salesforce, 10% of the workforce is going to go. Andy Jassy over at Amazon, and I'll talk about that a little bit later, 18,000 jobs are going to go. At what point does that start to become good news for some of these names, some of these stocks, and for the industry more broadly, that is starting to push harder on costs?
So we saw this about midway through last year, right? That we saw a lot of tech companies start to announce recession plans, start to talk about layoffs. I think the interesting thing when we look at the overall employment picture, though, is you have to say so technology, for example, represents more than 20% of the market capitalization of U.S. equities. However, it's only about 2 to 3% of the labor force. And so when we start to look at areas where we could see substantial job losses, we're actually looking to parts of the economy like residential construction. So housing was a big story in 2022, where you saw new home sales, resales decline by 30–40%. However, when you saw new housing starts, they only declined by a couple of percentage points. This is an area when you're talking about tight financial conditions where you're going to put capital to work, where we expect almost a loss of upwards of about 300 to 500,000 jobs. And so we have to look kind of at the sector and exposure when it comes to the overall labor force as to where we're really going to see that flow through into the job data.
And Kristen, also draw a distinction between what you think is about to happen with the economy and what's happened in the market already. Home builders last year, ugly, almost as soon as we kicked off 2022. So with that in mind, Kristen, can you help me understand where you think there are parts of the market that are further along in the adjustment process where you actually think there might be some opportunity?
I think that ultimately we're still pretty, as I mentioned earlier, we're still pretty defensively positioned. And so that's why we continue to be overweight fixed income. We believe that even within fixed income, we haven't seen credit spreads blow out. So even within our positioning there, we're still invested in quality. We like municipal bonds. We like preferred stocks at this level with financial issuers. And then on the equity side, we're still pretty defensively positioned, John, to be honest. We are looking towards those sectors like healthcare, global pharmaceuticals, those sectors that have been resilient and able to grow their earnings through the past 4 recessions. So healthcare is a great example, an 8% earnings growth. So we're sticking with that playbook.
Kristen, just finally on the bond market, you mentioned that, and excuse me for jumping in, but this move this morning up 12, 13 basis points on a front end on a 2-year to 448, on a 10-year up 8 basis points to 377. Kristen, what do you make of that move this morning off the back of some pretty resilient labour market data in the last 24 hours?
I think we're going to continue to see some of that volatility around the front end, and that just goes back to the market looking for whether there's some dovish signals or some hawkish signals. So that good news in terms of the resiliency and in terms of some of the jobs data is obviously influencing that movement. And basically, the market's anticipating a more hawkish message from Powell next Tuesday. And unless we start to see some of the breaks, either in a material decline in the trend in inflation or a break in employment, as I mentioned, areas like residential construction, the market is going to anticipate that you're going to still see that strong curve inversion and some pressure on the front end of the curve.
Payroll's coming up tomorrow morning. Kristen, thanks for jumping on with us. Appreciate it. As always, Kristen Bidley there on the latest in this market, latest in the bond market. Big moves. Your yield curve, 2s10s, negative 71 basis point. The 2-year up 12 or 13 basis points. The 10-year up by about 8 or 9 off the back of that economic data earlier. The equity market, 10 or 11 minutes into the session, down by more than 1% now on the S&P. On the Nasdaq, down by 1.4%. Coming up, Amazon joining the growing list of tech companies cutting jobs.
The big challenge for Amazon in the third quarter wasn't that their e-commerce was slowing. It was that their higher margin, higher growth cloud computing and advertising business were starting to feel the negative impact of a challenging macroeconomic environment.
That conversation up next with Brent Thill of Jefferies.
most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
The big challenge for Amazon in the third quarter wasn't that their e-commerce was slowing. It was that their higher margin, higher growth cloud computing and advertising business were starting to feel the negative impact of a challenging macroeconomic environment. So to the extent that you continue to see more weakness, then 10,000 could become 18,000, could become 30,000. We'll see how they continue to manage costs.
Another sign that the tech slump is getting worse. Amazon slashing more than 18,000 jobs in a cutback aimed at the corporate ranks. Brent Thill of Jefferies keeping his buy rating on the stock with a 135 price target. Brent, I'm pleased to say, joins us right now. Brent, fantastic to catch up with you, sir. It's been a while. Let's just start with this, and it's a question that I think has come across my desk, maybe yours, several times over the last 24 hours. It's a company of 1.5 million people. 18,000 jobs doesn't sound like a lot. It's not a lot. Why is this significant?
Well, I think it's a step in the right direction. To your point, it's a rounding error. It really doesn't have a meaningful impact. On a corporate side, obviously their corporate headcount is a lot lower. So maybe 1% of the overall headcount, but maybe closer to 4 to 5% of corporate headcount reduction. So if you look at Salesforce.com, Elastic, number of software companies, they're laying off 10 to 15% of their headcount. So it's been pretty consistent across tech. So this isn't shocking. The magnitude should probably be higher. It may end up being higher. Jefferies is forecasting a more prolonged recession and a later start to the recession, which is bad news, meaning this just gets dragged out, potentially even into 24. So that is the scary news of this whole thing, that this is probably the tip of potential layoffs in the tech industry. We've seen, again, a pretty massive hit to the industry, but I think based on what we're seeing and our economists are predicting, that this may end up being continued bad news, at least through the first half of 23.
So, Brent, this is super difficult to do, I know, but what kind of numbers are you thinking about? This is a company that added, what, 1 million jobs over 3 years or something like that? What kind of numbers reductions do you think are in store here?
I mean, it's hard to say, you know, a company with 1.5 million employees, they've said this, that they have overbuilt capacity in a massive way. And I think I go back to Andy Jassy is a software individual. Software individuals believe in high margin recurring revenue. They don't believe in taking risky bets all over the place. I think it's in his core DNA, in my opinion, having talked to him, that as a software investor for the last 20 years, I believe he believes in high recurring, high visible, high revenue revenue streams. And so if you believe that, I would expect he's going to take harder action on things like hardware, on lower margin products, and shift back to AWS and all the other categories that are producing incredible, profitable returns, and away from flying drones and away from all the experimental things that they've done. Yes, they want to innovate. Yes, they want to stay in the bleeding edge of building interesting technology. But I do think that maybe perhaps what happens here, especially with his arrival, is he leans back into these other businesses. So I think you're going to see the lower margin businesses get hit harder, and the higher mid businesses be less impacted. But clearly, all the high margin businesses of advertising, cloud, are under duress too. So I expect, again, I don't think this is the last cut across tech. I don't think it's the last cut at Amazon. And even if you look at Salesforce.com's cuts yesterday, they were pretty clear that this may not be the last one, that this is going to be a theme of producing good growth with profitability. Tech has been in a mode of just growing at any cost, and that game is over. It is about doing it in a responsible, profitable way. Investors won't tolerate it going forward. And so that just means there's going to effectively have to be more expense trims. It may not be headcount reduction, but it may be things around stores, warehouses, additional capacity that they're building out, we may see the cut there as well.
So, Brent, there's two things going on here. We've got the discipline of 4% interest rates on one side, and then on top of that, Brent, I can hear that you and the team are wrestling with this cyclical test that these tech companies are going to face, maybe in a way that they haven't in a long, long time, and for some names, if ever. Brent, can you put some numbers on it and help me understand what that's going to do to, say, growth in e-commerce, and even for AWS going forward from here?
I think the consumer's weaker. You're seeing this, and that's going to have an impact on items. We're still going to buy basic goods for our house from Amazon, but effectively buying the $400 Lego set, or buying all the other things that maybe are not necessarily required. We're going back to a must-have versus want-to-have. And so I think that's going to put weight on the consumer. I think you're seeing this across the board. We lowered our numbers on AWS and on Azure this morning. Mega cloud hyperscaler growth is slowing. Advertising growth is going to slow because the first thing that companies do in an economic recession is turn their advertising dollars off. So I think again, this is across tech. In the front half of the year, we're in for another reset of numbers, and hopefully we get reset enough so that we can actually start to create a bottom. I think we've cut numbers 6 or 7 times on Amazon. We haven't raised numbers in a year and a half. And again, part of this is created because of the pandemic. The pandemic created such a pull forward that you're digesting this pandemic pull forward, and then unfortunately, that pull forward then ends up meaning a recession, which is a double whammy.
Yeah.
And that's the hard thing right now.
So, Brent, here's the bigger challenge, and forgive me for jumping in. It's 135. 135 as a price target is what, 60% upside from here, and you talked about maybe things going better in the second half. Brent, they need to be a little bit better than that, don't they? They need to be great to get to 135. How do we get there?
Yeah, I mean, tech investors have to take a multi-year view right now. The economy is getting worse. Again, we're potentially going into a recession. And so what we've said is, is that tactically we've been very bearish on tech, but these are phenomenal, great franchises, and this is a great opportunity for longer-term investors. We're going to come out of this. The question is it 2024 or is it 2025? And ultimately, again, our house view is that this recession starts later and potentially longer. That is scary. And from that perspective, again, Nadella said this at Microsoft yesterday to an Indian news outlet, that it could be 2 years before the next tech boom. And that's Nadella, who's the most honest, upfront person on the planet. So that to me, again, you have to take that into context, is for long-term investors, these are incredible franchises. Amazon's durability and franchise in AWS, they are the 800-pound gorilla. No one's even close to them in cloud computing. I mean, Google and Microsoft market share combined, there's $15 billion of delta between the two combined market share. Amazon's so far ahead. So this is a great long-term franchise. But again, I think we have to stick with our clients are in energy, healthcare, out of equities in other vehicles, and that's okay. And so, like, the storm's coming through. I'm in San Francisco. There's a storm coming through San Francisco right now. Hunker down. Don't try to fight it. And I think that's the advice we've been saying is don't fight it in the front half. Let the numbers come down. Let the companies cut the numbers. They haven't been in front of the puck. They need to get in front of the puck, and they need to cut numbers and cut headcount more. Once they do that, you've cleared the deck. Multiples have compressed. So the good news is all the multiple compression is in. A lot of these multiples have been severely impaired. And so we need the companies to cut. We need us to stop talking about how bad it is and the companies to say how bad it is.
Yep.
And then investors will come back. But until they do that, they're not coming back into the tech pond.
Hey, Brent, it's a super difficult moment. And by the way, stay safe on the West Coast as well. Brent Thill, been too long. It's great to catch up. What a difficult moment for some of these names. Coming up, your trading diary from New York. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Sometimes it's pretty straightforward. The economic data is good. The Fed's telling you they're going to do more. Yields are up. Stocks are down by 1% on the S&P. On the NASDAQ, we're down by 1.2. That's the price action. Let's get you the trading diary. Coming up, President Biden speaking at 11:15 Eastern Time. The House reconvening at noon. Fed President Jim Bullard speaking shortly after, 1 p.m. Eastern, followed by Cook, Barkin, Bostic, and George, all speaking on Friday. And on Friday, of course, is the main event. It's Payrolls Friday, just around the corner. Looking for something in and around 200K on payroll. Special coverage, as always, right here on Bloomberg coming up tomorrow morning. From New York City, thank you for choosing Bloomberg TV. As always, this was the countdown to the open. I'll see you tomorrow morning. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it Donald
quits.
Trump's plan to overturn the
Unprecedented
election.
search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term. The pound falls to an all-time low.
The shortest ever serving prime minister.
President Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. it's a classic sort of momentum trade. They're going to wherever the winners are, and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I'm currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
when you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the, like, profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers.
the queen of live streaming, Via. She is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something because social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1996, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Ina co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100-kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for this one. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passy. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passy was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Hari Nada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian.
Hello, Mr. Hari.
And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Hari Nada was somebody who actually recruited me into the company. So I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Hari Nada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Hari Nada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Hari, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Ghosn Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who had spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this is a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them.
I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud. A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, the package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. You know, Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Baden-Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap
Connection
music.
lost.
And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we were just, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That, they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe
than by actually getting people on it.
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, You could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that The technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest, because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Yeah. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. Right. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everyone. It is Thursday, January 5th, 2022. Carol Masser, Tim Stenivek, live in our Bloomberg Interactive Broker studio, streaming on YouTube and on Bloomberg Quick Take. And I got to say, another day where Labor Day data makes a difference, but I'm also going to say another day where a Fed speaker makes a difference.
Or several Fed speakers that we've been hearing from.
Yes.
I mean, we got Bostic, we got Bullard. The list continues to go on. They can talk now, Carol, because there's not a Fed meeting until February.
Counting down already to when they cannot. All right, we're going to talk, though, about Fed news, Fed speakers, labor data, the dynamics with the markets in just a moment. Also ahead, Putin ploy or plausible change of heart. One insider is going to weigh in on that for us.
Also, Amazon hitting another milestone. This time, it's not a good one.
It isn't. Hedge funds also gorging on startups big time last year. So did it pay off? We'll tell you.
Plus, the Business Week cover story for the new issue of Bloomberg Business Week. It's on the Trump protege forging his way. We're not going to tell you who it is, but you've heard of him.
Yeah, we love this. And we're also going to tell you how much time you spent on social media last year and how you probably, I don't know, could spend a little bit more in 2023.
No thanks.
First up, did you get rid of Twitter?
I have in the past, and I got it back. It always comes back.
Right.
I always go back to Twitter.
All right, lots to come. First up, let's begin with a check on that trading day. Hey, Charlie Pellett.
Well, hello there. We are lower across the board. Red on the screen on the third trading day of 2023. S&P now down 32 points, down 0.8%. Stocks lower as investors grapple with continued evidence of strength in the labor market. We have got the Dow Jones Industrial Average down 278 points now, down 0.8%. Nasdaq down 104, drop there of 1%. 10-year yield ahead of the jobs report tomorrow morning, 3.70%, with the 2-year right now, 4.43%. Spot gold down $18 the ounce, down by 1% right now to $18.36, while West Texas Intermediate crude up today, up 2.2%, $74.44 barrel. Amazon.com delivering job cuts. It's laying off more than 18,000 employees, the biggest reduction in its history. Amazon shares down 1.5%. Bed Bath & Beyond says it might not be able to continue as a going concern, bringing another U.S. retail chain to the precipice of bankruptcy. Bed Bath & Beyond down now by 24.4%. And with earnings season just around the corner, what about the broader outlook for retailers, given today's news from both Amazon and Bed Bath & Beyond? Poonam Goyal is Senior Retail Analyst for Bloomberg Intelligence.
If you think about what we saw over the holiday, we did have a good holiday season. Adobe just came out with their e-commerce numbers. Holiday sales were up 3.5%, and that's better than they had estimated. So overall good, but I think when we start to see earnings later this month and into February, there will be mixed reads, because remember, there was a snowstorm right in the Northeast right ahead of the Christmas season.
Stitch Fix is cutting about 20% of salaried employees. It also says CEO Elizabeth Spaulding will step down. Stitch Fix shares, they're up now by 8.1%. Recapping, stocks lower with the S&P down 29, drop there of 0.8%. I'm Charlie Pellett, and that is a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellett, thank you so much. All right, let's get to the market drivers report. Let's set the Business Week agenda. We got a lot to get to, folks. Watching the markets, watching also what's going on in the world of economics here in the U.S. Kriti Gupta, anchor and markets correspondent at Bloomberg. She's in our Interactive Brokers studio, along with Mike McKee, international economics and policy correspondent at Bloomberg News. First up, so where do I go?
Eeny, meeny, miny, mo.
We have a winner here.
I love them both. But I do want to get to Mike, because I do feel like the economic news was a big deal today, and we're one day away, less than 24 hours away from the monthly jobs.
Yeah, you want a big deal. That'll be tomorrow.
Yes.
If you ask nicely, maybe I'll come back.
Please.
I mean, the numbers today got traded on, and the Fed guys got traded on, but it's really, neither is really that important. The problem with jobless claims right now is it's the holidays. And because the holidays, you have one fewer day in the New Year's week, one fewer day in the Christmas week, and so the numbers are going to go down because fewer people are able to get out. And also, you don't have as many people who actually get fired and lose their jobs. They might get an announcement. So we really can't tell a whole lot from the level. It's not a surprise that it went down. And ADP is just too new, the way they have rejiggered it, to know what its relationship is to non-farm payrolls. For the last 4 months, ADP's come in lower than non-farm payrolls. So if there is a trend, it could be that we see a bigger than expected jobs gain tomorrow. But ADP has always gotten traded on, even though it doesn't have a particular function.
I always find that funny, right? That we don't really necessarily respect a data point, but nonetheless, we do trade on it.
You got to trade on something if you're a trader.
Mike, are they trading on what we heard from Fed speakers today? Fed's Bullard saying that rates are nearing a sufficiently high level. Atlanta Fed's Bostic says inflation is way too high in the U.S. George says the Fed should hold rates above 5% well into 2024.
Yeah, well, we're starting to see a slow shift from we're going to keep raising rates over 5%. You're still getting some of that to the idea that they're going to hold rates. I think the minutes yesterday were designed to sort of whack the markets upside the head and say, you got to believe us. We're going to hold rates at a high level for a long time. No more of this pricing in rate cuts kind of thing. And that's what we're getting out of them today.
All right, so Kriti, come on in on it. So what did we see in terms of, because we did have a Bloomberg write-through that says, hey, markets did react to those Bullard, he was a known hawk, right, and seemingly dovish comments, but did we see any kind of real market reaction?
I broke the headlines on Bullard on air just moments ago, or about 30 minutes ago or so, and you didn't see an immediate market reaction to me, which I think is interesting. I would say the story is still the payrolls data that is coming tomorrow, and I almost wonder, Mike's right, traders don't usually trade on ADP data. It's kind of seen as something you're like, oh, well, that's cute. And then you just kind of like put it, or you kind of brush it off your shoulder. But this is the first time where I think I'm almost wondering if it's kind of a pull ahead from yesterday because the reaction has been so dramatic. I mean, at session lows, we were down, I'm going to say 1.3% on the S&P 500 when we were in positive territory at 8:29 a.m. this morning. So to me, that is more significant, especially when you're seeing it mirrored by the move in treasuries, the move in the dollar, move in commodities.
Talk to me about the treasury trade, because I feel like that's the one with all this economic data talk and points
Well, it's
out.
all, I would argue, all just one trade, and you can see that on the intraday, the charts. The 10-year yield, I mean, it's up 2 basis points right now, but the move, I'm just kind of doing my quick math here, was 8 basis points on the headline itself. So 370 on the 10-year yield. That move gets more dramatic when you look at the front end of the curve naturally because of the Fed. But to me, I think the story is the dollar here, because going into the last week of trading last year and also most of this week, the dollar has been in the red. So to see the dollar kind of bounce back and, by the way, follow tick by tick what the bond space is doing, I think that's significant. Once again, it's all happening at the same time, where you have stocks dropping, yields higher, the dollar following yields, the commodity space following the dollar. So it's all kind of a ripple effect, and therefore all one big trade. But I think the takeaway here is, if this is today's trade, does tomorrow's trade get more dramatic or less dramatic?
I don't know.
That's a hard call to make. I would say we're in a period now where, because we're data dependent, a one day's moves are one day's moves. The next day is going to be something different that people are going to be adjusting their investments.
One thing I want to ask you, how do you look at the labor data that comes out, whether it's today, this week, in a couple of weeks, against, Amazon again, counting, a headcount cut, their largest, I think, on record for them. So, it seems like every day we do see announcements, and yet the labor market data kind of continues to support a pretty tight labor market.
Kriti and I did a whole segment on this.
Well, we tried. Was it point counterpoint kind of thing?
No. She asked me about it. I made the point that, first of all, for Amazon, it's 0.01% of their labor force. They have 1.5 million people working there. Okay. And tech companies in general are a very small part of the overall labor force. There's 155 million jobs.
So it doesn't move the needle, you mean?
Doesn't move the needle from tech. If you had the auto industry, General Motors laying off 10% of their workers, that would be a different story. But in this case, it doesn't really move the needle very much. Plus, these are also very highly educated people who are skilled, and they're going to pick up jobs reasonably quickly. So it's not a major problem. It's just that tech dominates the indexes, and so tech dominates our news, and everybody kind of focuses on it.
But can I offer a counterpoint to that?
Sure.
I'm going to steal it from Tom Forte over at D.A. Davidson, because he made this point on surveillance this morning. He was saying that, look, it is a small number when you're looking at the 1.5 million, but you have to look at Amazon's workforce as the blue-collar workers who work in the warehouses, do logistics, and the white-collar workers who work on the actual kind of business model itself. And if you look at the white-collar workers, that's a workforce of about 10,000, I think.
No,
and
350,000 total.
350,000,
Yeah,
excuse me.
350,000.
So, but still smaller than 1.5 million.
For sure.
And therefore, 18,000 may be more significant in that light.
Just so Critty and I can take over your show here.
That's fine. Go ahead.
Okay, it's like watching a tennis match.
Yeah,
Kind of
the point I would make there is, if you read Andy Jassy's memo to the staff about this, first thing is it appears that this 18,000 includes previously announced cuts of blue-collar workers, warehouse workers. And second, that for Amazon, the number of people that they're talking about is pretty small. And when you're talking about in the memo, he said, we're eliminating positions, not firing people. So it may be that it's jobs
Tell
that
the
aren't
people who
filled.
lose their jobs.
I mean,
well, maybe there's jobs that are not
Spencer
filled.
Soper
I
points
know.
out in his story about this. Some people are in recruiting and human resources and in hardware divisions that have been eliminated.
There may be empty seats. That,
Right.
We're just not going to fill that job.
You don't need
and
recruiters.
That counts as 18,000.
If you're not hiring people, you don't need
that's
recruiters.
Hey, Mike, one last question. As we had a barrage of Fed speakers, we will have more as we get ready for that first Fed meeting on February 1st. Who do you pay the most attention to? I know we've talked about this, but I feel like there are times a lot of stuff comes across. And do you feel like it's one cohesive thought at this point?
Well, strategy is cohesive. Tactics is just a question of how high you think you need to go on interest rates.
Yeah.
And that's where we're seeing a little bit of a difference between people. And I don't think there's any one person. I mean, I would look to Jay Powell.
Okay.
But in the past, in terms of setting a bar, was somebody like Jim Bullard or Chris Waller. But that bar has been set. Now we're kind of just waiting for them to get to the top. We are kind of, this will be the question tomorrow.
Yeah.
If we get a strong number, we're back to the 50 or 25 question, because they suggested they were going to do 25, but if we get a really strong jobs number,
right.
you can ask all of your guests tomorrow.
Mike, we're going to ask you because we know you're going to stay late and you're going to get in early. And stay in our program.
This is why a wise
We
man
appreciate
says
it.
to me, like Fed speak, the macro conversations, man, they can change from day to day. And so I don't know.
Was it Mike McKee who said that?
Well, he's a wise man too,
Okay.
but no, it was not that man.
I'm
All
just
right.
an old man.
Not true.
No, one of our favorite speakers here at Bloomberg, Michael McKee, international economics and policy correspondent. Our thanks to Mike, as well as Kriti Gupta, anchor and markets correspondent here at Bloomberg, both in our studio. All right, we all know, we want to talk a little bit about, we know it was tough for public markets, but what about the private markets, Tim?
Yeah, those high-flying private companies such as Discord, Stripe, Instacart, Chime, and more, something that hedge funds really gorged on big time last year. How much value did those companies create in 2022? The story a most read on the Bloomberg today. With more, we've got Bloomberg News hedge fund reporter Hema Parmar with us in our Bloomberg Interactive Brokers studio with more. Love this story, Hema. You did some exclusive analysis for this story today, among the most read on the Bloomberg terminal. Just how bad was it for hedge funds? And also, how did you do it? Because these private market valuations, they don't get revised very frequently.
Right. So hedge funds generally, the crossover funds, those that do both public and private investing, had a very difficult year. We've reported about this extensively, down double digits. And on the private side, the story really talks about how obscure these markets really are. Nobody really knows exactly how much these companies are worth. It's not like the stock market where everyone knows every single second what a company is worth. And so what we did is we looked at, well, what companies, private companies, are mutual funds invested in that hedge funds are also invested in? Because mutual funds have to disclose publicly how the marks for their companies over time.
Right.
Hedge funds don't have to disclose that publicly. And so we looked at an array of companies, 46 of them, and we said, okay, well, through our analysis with our data team, these mutual funds marked down about 70% of the 46 companies, with average decline of 35%, with some down as much as 85%.
That's pretty intense.
So it shows really just the extent of these markdowns and how bad it could be for some of these funds.
So then talk to us about the hedge fund environment. I mean, they were all in 2022.
Yes, a lot of them pushed ferociously into privates last year, the year before. Now, the interesting thing is that every firm can mark their private companies differently. And it could be because of their structure.
Yeah.
Maybe they asked for special terms in their investment. It could be because of their size of their investment. It could be when they got in. But that just makes it all the harder to figure out, like, what is it worth?
But companies like T. Rowe Price and Fidelity want to make sure that they're accurate because they actually have these invested as parts of mutual funds that people can invest in, right?
Yes. So the
How does that
liquidity,
work?
yes. So because mutual funds are so liquid, they have to mark these things a lot more frequently. And because people may want to redeem more often, they will be maybe even overly cautious about marking things down, aggressively so that people are not overpaid when they are redeeming, or when people are getting in, they're not buying in too expensive. So you could see more aggressive markdowns in the mutual funds than anywhere else. And if you look in our story, we even show dispersion amongst mutual funds. So in some cases, the mutual funds generally agree on a company, and in some cases, they really don't. If you look at ByteDance, the dot plot that we have here shows mutual funds generally did not agree on how much ByteDance was worth at any point in the past year. And the spread is pretty significant.
Well, for someone who follows the hedge fund industry, like, so how do you think about it and potentially the stories we might see play out in 2023?
Yes. So I think as we look through the rest of this year, we've been already seeing some struggling news of startup companies firing a lot more people, struggling with revenue. If that continues, firms are going to have to either mark their underlying companies down, or you might see companies mark themselves down increasingly. And so if that continues, it basically bodes more pain.
One thing I have to ask you, though, because I feel like whenever there's even a bad hedge fund year, there's still a ton of money that comes into the hedge fund industry. Where were assets last year compared to the year before?
I think about on pace. I think last time we talked, there were $4 trillion. Generally speaking, the money is flowing into the bigger firms, into the bigger known names.
But it's still coming in.
I think it's still coming in. And generally, we have seen some redemptions this year, but I wouldn't say so much so that it makes a huge dent into the $4 trillion number.
Okay, so here's my question. It's about, it wasn't all bad news. There were some companies that were actually marked up last year. And there's a great graphic in this. So read it on the Bloomberg terminal.
We just showed it for the folks on YouTube. Maybe we can bring it back up.
I wasn't watching.
For YouTube and Quick Take.
And what it shows is that there are companies in here like ByteDance, SpaceX, and a couple others that actually did pretty well.
Yes.
A small minority. In 20 seconds, what was unique about these companies or how they were valued?
Yeah, so some companies are doing fine. Some companies are able to raise money, are able to raise money at a premium, may have enough money, maybe raised enough in the past that they can keep going without needing to go back to the market. And so it's not pain across the board by any means. There's a lot of pain, but it certainly doesn't mean that the companies can't do an up round or be okay or be marked up.
Even if it gets to be a tougher economic environment, just a few seconds left.
Potentially, I mean, I think so much is yet to be seen, and this is such a tricky, obscure space. I think we'll see a lot of pain ahead, but I think we'll also see some successes. So,
which is the hedge fund world, right?
Which is the hedge fund world.
Which is always why it's fascinating we cover it so well, like Hema Parmar does. She's Bloomberg News hedge fund reporter here in our Interactive Brokers studio. You are listening and watching Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks do remain lower. Federal Reserve Bank of St. Louis President Jim Bullard says central bank has almost raised rates as high as needed to tame inflation. S&P off session lows, down 33, drop there of 0.9%. The Dow also down 0.9%. Nasdaq, the selling continues, down by 1%. 10-year yield 3.71%. The 2-year 4.45%. Spot gold down $20 the ounce, down 1.1%, 1834. West Texas Intermediate crude up 1.3%, 73.80 a barrel. Briefly, Delta plans to offer free Wi-Fi starting February 1st. That, according to CNBC. JetBlue says it will offer a new daytime flight option from New York to London. JetBlue down 0.2%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, this week's Bloomberg Business Week cover story, it's on newsstands, The Issue, online at Bloomberg.com/businessweek, and always on the Bloomberg terminal. The cover story centers on a man who looks poised to run for the highest office in the land come 2024 and how his rhetoric is finding traction within the Republican grassroots circles.
The story, also today's Bloomberg Big Take. With this story, we turn to Bloomberg Business Week national correspondent Josh Crean, who joins us on the phone from Washington. Also with us in the Bloomberg Interactive Brokers studio is the editor of the magazine, Joel Weber. Joel, we're talking about Florida Governor Ron DeSantis.
Yeah, obviously there's sort of been a mess in D.C. this week. But I think almost the bigger political story that is going to perhaps have a longer trajectory is the Ron DeSantis narrative. And we've been obsessed with this one for a while, especially coming out of midterms, because what midterms really showed was how much of Florida has been galvanized behind Ron DeSantis. And now the question becomes, can Ron DeSantis actually take that narrative and make it be a national one? And to do that, Josh pointed out something that I thought was just incredible, which is, unlike many Republican predecessors, DeSantis has managed to put a target on business in a way that no one else has ever done before. And that has really galvanized a grassroots support behind DeSantis. So Josh, turn it over to you. What did you learn about Ron DeSantis as you were working on this story?
Well, I mean, the interesting thing to me when I set out to do this story in the fall was that here was a guy who's clearly talented, clearly wants to run for president in 2024, and yet faces the same big impediment that every other Republican who wants to run for president does, and that's Donald Trump, who's like the 800-pound gorilla and has managed to kind of sideline all comers. What's so interesting about DeSantis and what sets him apart from other Republicans like Mike Pence or Mike Pompeo, secondary Trump figures who are known to kind of want to run for president, is that he's cracked the code of how do you build a profile for yourself among grassroots Republicans that isn't contingent on your standing with Donald Trump. And the way that DeSantis has managed to do that is by starting the big kind of culture war grievances that Republicans love, that the Fox News audiences love. Only unlike Trump, which makes everything about him, DeSantis has made it about business and corporate America and companies like Disney and their alleged wokeism. And that's really struck a chord with a lot of grassroots conservative followers who are now lining up behind DeSantis, and it turned him into a viable threat, I think, to win the nomination in 2024.
How is it that business former friend of the GOP, all of a sudden has been a great enemy that DeSantis has been able to leverage?
It's a great question. It sort of happened gradually. Business has always been the great ally of the traditional Republican establishment. They've been simpatico on policy. They've helped fund a lot of these guys. But DeSantis is an interesting case in that he's always been a bit of an outsider. When he first ran for governor in 2018, he was like languishing in third place and was not the choice of the business community. In fact, the big businesses in Florida, like sugar and construction, attacked DeSantis because they had another candidate in mind. But DeSantis very cleverly warmed up to Donald Trump, got Trump's endorsement, and that vaulted him into the governor's mansion. And I think DeSantis feels like, A, he really doesn't owe anything to big business. He hasn't had any problems raising money. But B, more and more people, I think, in our culture view big business as an enemy or a player in the culture wars in a way that maybe they didn't a generation ago. So you've got the George Floyd protests, you have Colin Kaepernick protests on police violence with Nike. Corporate America has become politicized, and what DeSantis has done is really leverage that for his own political needs.
Actually, you mentioned some big industry there. One of the things that I thought was so interesting in the story that I learned was that his willingness to take on big sugar, and you briefly mentioned that. But just slow that down for a second. I mean, you cannot imagine a bigger industry in Florida than sugar, and the first thing that Ron DeSantis does is take on big sugar. What did he learn from that, and what did others learn about him in the process?
Well, what's interesting about the historical context, I mean, sugar is one of the big industries there, has a ton of money, is very actively involved in politics. And in 2018, they were supporting the state agriculture commissioner who was their guy, and they ran a lot of negative ads on DeSantis. If you step back, though, and think about what sugar needs in the context of modern Republican politics, they need cheap immigrant labor, and they want open markets. Well, what's been the big change in Republican politics since Donald Trump came in? He's turned the party very anti-immigrant and very anti-trade. And so that helped drive a wedge, I think, between traditional Republicans and kind of Trump-DeSantis-style Republicans. So it's much easier for DeSantis to go out and attack sugar, not based on kind of state economic grounds, but more on culture and on issues of, should they be able to use immigrant labor? Well, I know from being at tons of Trump rallies, DeSantis campaign events, that Republicans still really care about immigration. And so, while sugar has a lot of powerful lobbyists, still has a lot of political sway in Florida, they don't have nearly the sway that they did, 10, 15 years ago when Jeb Bush was president. And, you have this kind of populist uprising that certainly saw in 2016 around Donald Trump and a lot of other candidates, that now, at least Florida, has gravitated very strongly to Ron DeSantis. And it's worth pointing out, this isn't just Republicans and Trump supporters. He also won a lot of independents and a lot of Democratic voters, too. So he's really come up with a formula that has worked well in Florida and could conceivably work on the national level, too.
But can he take on Donald Trump? Can he go head-to-head with Donald Trump? As we've learned in the midterms, DeSantis was very popular, Trump not so much. But as you write, people have made the mistake of counting out Trump before.
Yeah, and DeSantis' strategy, when I was down there, Trump was still considered this big, imposing figure. And DeSantis' strategy has been to ignore him entirely, to put off that fight to another day.
Did you say DeSantis or DeSanctimonious?
Yeah, even when Trump called him, Ron DeSanctimonious, and tried to start a fight with him, DeSantis just ignored it. And, even in the weeks since I was down in Florida, there's been kind of a vibe shift in Republican politics where suddenly Donald Trump doesn't seem quite as big and scary as he once did. I mean, part of that is that Republicans fared so poorly, especially Trump's candidates in the midterm elections. But he just seems to be a shrunken figure compared to what he was 6 months or a year ago. So at least for the time being, DeSantis is the hot brand among Republican donors and a lot of Republican voters. But as you said, at some point, if he wants the Republican nomination, he's going to have to get up on a debate stage and challenge Donald Trump. And so far, nobody has done that and survived. So maybe he'll be the first.
So he's taken on this corporate wokeness. Where does he go from here as a candidate if he's going to actually go to this national stage?
Well, it's working for him. I mean, he started out with Disney and criticizing a lot of the companies that were openly supporting Black Lives Matters after George Floyd's murder in Minneapolis. What's happened since then is that I think he's recognized that this really resonates, and he's broadened out the fight on corporate wokeness to focus on big Wall Street banks and big asset managers, companies like BlackRock, people like BlackRock's CEO, Larry Fink. He's kind of turned them into the new villains for Republicans because, there's never going to be a lot of grassroots support for Wall Street firms. But he's claiming that they are woke, that they're diverting traditional capitalist goals of building shareholder value in order to pursue liberal social justice goals like curbing global warming and so on. There's a degree of truth in what he's saying, but everything I've seen is that this really does resonate with Republican voters. If you watch Fox News prime time, maybe not this week with the chaos we have going on down here in Washington, right. But any other week, And this is something that Republicans care about. It looks like it's resonating, and that's all good for Ron DeSantis' political future.
Josh, I'm stealing your words here, but you kind of ask in your story, can though DeSantis replace Trump's rages? For example, you write, can DeSantis' attacks on ESG and Larry Fink eclipse Trump's crusade of crooked Hillary and Lion Ted in the pantheon of MAGA villains? It's a great question. Like, can it resonate nationally?
Yeah, and I don't think we have an answer to that yet. I mean, I'll be honest, I was a little skeptical going into this piece, but I went down, I traveled around Florida, talked to a lot of politicians, including Democrats, talked to some Fox News producers, people like that, and it really does register. And it's not just Ron DeSantis saying this. I mean, you have other candidates like Mike Pence who are now trying to hop on the wokeness bandwagon. It's just something that seems to resonate with Republicans. So at least so far, it's working for DeSantis. But again, at some point, you're going to have to confront Donald Trump, and that's a showdown we haven't seen yet.
Last question. It's a quickie. What's it like to try and cover DeSantis?
It isn't easy. He doesn't, part of his shtick is he hates the press and he keeps them penned up in rallies. So he won't talk to non-right-wing reporters. But a lot of people at his rallies, very forthcoming, very eager to talk to him. And, not just Trump people and conservatives, but I ran into lots of independents and Democrats too. So he's certainly somebody I think that a lot of political experts are bullish on.
Josh, yes or no? Well, if they both are on the debate stage, will they both be throwing baseball caps into the audience?
Yeah, I guarantee it. I guarantee it.
Josh Green, the cover story of Bloomberg Business Week. Thank you so much, and our thanks to Joel Weber as well.
Let's get a check on the latest world and national news. Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. It's the third day of House efforts to elect a speaker, and once again, the job still seems out of reach of Kevin McCarthy, with a loss in the 7th round and now an apparent loss in the 8th round now underway.
McCarthy was nominated by a newly elected Republican, John James.
I don't need D.C. politicians to tell me how broken D.C. is. The American people have already told us by giving Republicans the majority so we can fix this mess.
Democrat Pete Aguilar focused on another issue for Hakeem Jeffries.
Hakeem has stood up against voter suppression and the new Jim Crow era every step of the way.
Then Republican Dan Bishop took the floor.
We are committed to make change to this institution that has lost its way.
Bishop again nominated Byron Daniels. In Washington, Irv Chapman, Bloomberg Radio.
Pope Benedict XVI is being mourned today after Pope Francis presided over his funeral at St. Peter's Square in the Vatican. Benedict resigned as Pope in 2013, becoming the first Pope in 600 years to do so. He died New Year's Eve at the age of 95. Russian President Vladimir Putin has ordered a 36-hour ceasefire in Ukraine starting at noon tomorrow Moscow time. The Kremlin says it's to mark Russian Orthodox Christmas after an appeal from the church's patriarch. Bloomberg's Mark Champion reports this should be taken with a grain of salt.
These kinds of ceasefires, if you look at previous wars like the war in Yugoslavia, back in the 90s, there were just dozens of, temporary ceasefires of this kind that were called. Some were supposed to be longer, collapsed very quickly. This one seems to be, really a gesture more than anything else.
Bloomberg's Mark Champion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are now lower across the board, weighed down by strong labor market data, which is likely to keep the Fed firmly on its path of rate hikes. Weekly jobless claims fell to 204,000, close to a record low. So what about the Federal Reserve and the path of rate hikes this year? Deborah Cunningham is Chief Investment Officer at Federated Investment Management. She was interviewed this morning on Bloomberg Surveillance.
If you read yesterday's FOMC minute, they're not done yet. They are very cautious. They're going to continue this process. Yes, they are aware and, watching what happens from an economic perspective, but their goal is to bring inflation down. They're doing a good job of it, but it's not done yet at this point.
S&P now lower by 27 points, down 0.7%. Dow Industrials also down by 0.7%, down 231 points. We've got NASDAQ down 88. That is a drop right now of about 0.9%. 10-year yield 3.71%, with the 2-year yielding 4.44%. Spot gold 18.34 the ounce, down 1.1%. Crude up by 1.5% right now, $73.93 a barrel. Bitcoin up 0.1%, 16,844. Genesis Global Trading, based in New York, has laid off more than 60 employees in the latest round of job cuts, amounting to roughly 30% of the troubled crypto brokerage's workforce. Coinbase lower by almost 10% after the cryptocurrency exchange was downgraded to market perform from outperform at Cowen. And Silvergate Capital shares are plunging after the bank said the crypto industry's meltdown triggered a run on deposits. Silvergate shares down now by 40.6%. Recapping, stocks lower, S&P down 27, a drop of 0.7%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Bloomberg Quick Take out today. They are noting that there is a new COVID variant. It's nicknamed the Kraken variant that was detected last year and has become the dominant strain here in the United States, identified in 28 countries, according to the WHO, and there have not been any reported significant differences in severity, which makes me happy.
But what do we need to know about it? We've got a great guest with us this afternoon. Carrie Althoff is Associate Professor of Epidemiology at the Johns Hopkins Bloomberg School of Public Health. It is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. She joins us on the phone from Baltimore. Dr. Althoff, it's good to have you back with us. It has been a while since we last spoke, and perhaps it's a sign that things are concerning when it comes to this new variant, that you are back with us and speaking about this so-called Kraken variant. What does our audience need to know?
So this variant, we believe, is pretty transmissible. What we saw happen in December was that it went from a circulating variant to really growing in the proportion of specimens that we look at to see what variants are circulating. It's now up to about 40% of those specimens that we're capturing, which was about a tenfold increase from 4% to about 40% in the month of December. So we do know this is highly transmissible, and therefore we start asking these additional questions like severity. We are seeing just slight increases in hospitalizations the way we expect after the holiday gatherings, what we were kind of anticipating after the holiday gatherings. And we also note that XBB.1.5, which is the scientific term, it's really dominant in the northeast of the United States, but we're not seeing differential hospitalizations there. So we're hoping that this early and yet still inconclusive evidence that this is not a more severe strain causing more severe disease is true. We're also looking at that vaccine. The bivalent vaccine does have Omicron variants in it, and XBB.1.5 is a subvariant of the Omicron virus. So really having that bivalent vaccine is important. And right now, we see only 38% of adults over 65 who are at highest risk for severe disease are actually vaccinated with the bivalent booster. So to protect yourself from severe disease from this XBB.1.5, bivalent boosters are the way to go.
Dr. Althoff, What worries you more right now, these COVID variants and COVID cases still out in our communities, or the flu, which I know a lot of folks in my family, I've seen it, and others where they're like, man, the flu knocked me out for 2 weeks. What is it that worries you a little bit more and that might be more problematic to our health right now?
You know what? I think it's the combination, right? So we've seen RSV start to come down, which is great because that was differentially impacting our very old and our very young. We are seeing influenza, and particularly the A strains, are really still going strong. And just as you said, people are getting pretty ill, getting down and out for days, if not weeks on end. It's taking a while for some folks to recover, and it again is affecting our oldest and our youngest. So we are trying to make sure that this combination is not resulting in a higher capacity, or reaching capacity at hospitals, right? Because that's really our biggest concern. And so what that means is that, again, vaccines, we have flu vaccines. It's not necessarily, again, going to protect you from the infection, but will it keep you out of the hospital? It will definitely reduce your risk of hospitalization, particularly among the young and the old, who we see are at greatest risk for that severe disease from influenza. But yeah, flu ripped through my house too. It is no joke.
What about when it comes to an RSV vaccine? How close are we to one of those, especially for kids who are the most vulnerable?
There have been trials of RSV vaccines that have gone on for many, many years. There is one we are getting excited about. It is coming down the pike, and we are hopeful that we will be able to share that good news that there is an RSV vaccine that is safe and effective relatively soon.
Are you involved in the study?
No,
Okay.
no, not me. We as the scientific community.
Okay.
But I think the thing that is most important to recognize about that is for parents of young kids right now, and for people who regularly interact with older adults and care for older adults, particularly in residential settings, that vaccine is not here now, and RSV is. It's very real. It's starting to come down, which is good news, but we're still very cautious because it could go back up. We're still watching.
Hey, I am curious, too, how much you're keeping an eye on what's going on in China specifically, right? I feel like, going back to the early days of 2020, where we were seeing, high deaths, high hospitalizations, bodies piling up, unfortunately. We're seeing that play out in China right now. Are you at all concerned that what's happening to China could ultimately lead to some kind of spike or new variant coming into the United States?
So first of all, what we're hearing coming out of China, it is devastating. It's devastating for the people of China. And it's important to note that they do not have a very high vaccination rate among older adults who we know are at greatest risk of severe illness and death from COVID. And so that's really where my concern lays, is that these older adults are pretty unprotected, and that is going to impact how this wave of illness that they are seeing plays out in terms of the impact on that country's health. I think overall, as a global community, absolutely we are concerned, because anytime you have this much replicating virus, replications lead to mutations, and mutations lead to new variants. And so absolutely, this is not just a really hard moment for the people of China as they kind of attempt to get through this wave, but it is also a very concerning moment globally.
Dr. Althoff, just in the last minute we have, I want to end on somewhat of an optimistic note. I hope it is, because your specialty is studying HIV. And if I think about my lifetime, the way that an HIV diagnosis when I was a kid was like a death sentence, to the change as it is now, when there are so many people who are living healthy with the virus. What does that say about how quickly we can overcome the next virus that we find, or different variants of COVID, and how quickly medical science is able to change in really just one generation?
I mean, I think what we've seen in terms of scientific advancement under COVID is really, it's a moment that if I ever see anything like this again in my career, I will be just as surprised as I am right now with the advancements that we've made. I'm also very hopeful that the advancements that we've made in COVID will start to translate to other settings, including a potential HIV vaccine. And so these are the pieces of this terrible pandemic that are the silver linings for us. And hopefully we will continue to see this with good funded research from our government.
Well, we always appreciate checking in with you and the Johns Hopkins team. Dr. Carrie Althoff, Associate Professor of Epidemiology at Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. This is Bloomberg Radio.
is 2:53 on Wall Street. Charlie Pellet with a look at today's company headlines. Amazon laying off more than 18,000 employees, the biggest reduction in its history, in the latest sign that a tech industry slump is deepening. Tom Forte is senior research analyst at D.A. Davidson. He says Amazon is not alone.
E-commerce companies in general overestimated demand for the current state of the pandemic. Not just Amazon, you see it at Wayfair, you see it at Shopify. So I think that what happened was initially when the stores were closed, consumers leaned into e-commerce to such extensive levels that there was an expectation that those levels would hold.
And Amazon shares right now, they are down 1.2%. Genesis Global Trading has laid off more than 60 employees in its latest round of job cuts, amounting to roughly 30% of the troubled crypto brokerage's workforce. Comcast shares are higher after Truist upgraded the cable company to buy from hold. Charter Communications also higher. Right now, we have got shares of Comcast up 1.4%, Charter up now by 3.2%. Gap and Victoria's Secret both lower after a UBS analyst has cut his recommendation on both retailers to sell from neutral. Shares of Gap, they're down 2.8%. Victoria's Secret down by 6.3%. Novocure shares are surging after saying a study evaluating the safety and efficacy of tumor-treating fields in stage 4 non-small cell lung cancer met its primary endpoint. I'm Charlie Pellet.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
It's Bloomberg Business Week on this Thursday afternoon. Let's get to world and national news. Nancy Lyons is in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Still no breakthrough on the push to elect a House Speaker. Kevin McCarthy has once again failed to receive enough support in 2 more votes today. Former White House Chief of Staff Mick Mulvaney spoke with Bloomberg's Joe Matthew about the ongoing drama and suggested a tangible solution involving a GOP deal with Democrats.
We'll offer you a compromise candidate. I've used Fred Upton's name. Fred's a friend of mine. He's a moderate Republican. He doesn't mind me doing this. I said, look, we want Fred as Speaker. Yeah. You guys all vote for Fred, and what we'll do in return is we promise no investigations. There's no subpoenas. We'll do legislation, but no investigations. That'd be a huge win for the Democrats and a reason for them to support a coalition candidate.
Again, Mick Mulvaney speaking with Bloomberg. Buffalo Bills player Damar Hamlin is beginning to wake up after suffering cardiac arrest during Monday Night Football. Dr. Timothy Pritz with the University of Cincinnati Medical Center provided an update today.
We would like to share that there has been substantial improvement in his condition over the past 24 hours. We had significant concern about him after the injury and after the event that happened on the field. But he is making substantial progress.
Dr. Pritz says Hamlin is moving his hands and feet, but it's too soon to determine whether he'll make a full recovery. The NFL today said the game between the Bills and the Bengals will not resume. Brian Kohberger, who is accused of stabbing to death 4 Idaho college students in their beds, appeared in an Idaho courtroom today. Judge Megan Marshall informed the 28-year-old of the severity of the charges against him.
The maximum penalty for this offense, if you were to plead guilty or be found guilty, is death or imprisonment for life. Do you understand?
Yes.
Court documents reveal some of the evidence now in the case, like a knife sheath that was left behind with Kohberger's DNA and cell phone data showing he was in the area of the victim's home multiple times. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
Thank you so much, Nancy Lyons. Bloomberg Business Week is brought to you by Innovation Refunds. Are you looking for ways to grow your business? Get back the money that you may be eligible to receive through the Employee Retention Credit. Sign up now before it's too late. See if your business qualifies for ERC assistance at getrefunds.com.
All right, you are listening and watching Bloomberg Business Week. We're watching the markets, and we're watching one name in particular. I know Charlie's been talking about it, and I feel like we all have. Bed Bath & Beyond. To be fair, this is a name that we have talked about for years, certainly here on this show, because we've seen the troubles. I've kind of joked about it that I go into it and I get lost in the store, and it's kind of an interesting place. You can pick up a lot of different things, but many have said it's kind of got to maybe rethink its strategy. Well, the strategy right now, and we've all been reporting on this, that the company has called off a proposed debt exchange, saying it might not be able to continue as a going concern, bringing another U.S. retail chain to the precipice of bankruptcy. And apparently it's considering a lot of different options: restructuring debt, selling assets, or filing for bankruptcy court protection, but added these measures may not be successful.
The home goods retailer also pulled the outstanding debt exchange offer that would have given creditors a chance to swap unsecured bonds for a lower face value amount of new secured obligations. Moving forward with the plan, which aimed to trim the company's overall debt load, could have complicated a potential bankruptcy.
And it's interesting, we're talking about some suppliers halting shipments to the company. I mean, this is a stock that is down almost 24% in today's trade. It trades for $1.83. Just a very different story. We know a lot of retailers have had a tough couple of years, but again, in a very, very competitive environment where you can buy a lot of different places, it can be tough for those retailers that maybe don't have a strong identity.
It's trading at $1.83 right now.
Yeah.
KeyBank says that shares are only worth a dime.
Yeah, that's really low. All right, folks, we're going to continue to track it. As we said, this stock under pressure. Carol Massar, Tim Stenivek, we're going to head over to our TV colleagues, talk about the markets. Right now, Bloomberg's countdown to the close starts right now.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left in the trading day. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Master and Tim Stenovic, and welcome to all of our audiences across Bloomberg Television, Bloomberg Radio, as well as on our Quick Take and YouTube platforms. And Carol, it's an interesting turnaround from what we saw yesterday. There seemed to be this sentiment, this optimism that the Fed was probably near the tail end of that rate hiking cycle. And then we got that ADP number, a presage maybe to tomorrow's NFP number that still shows a relatively strong labor market.
Yeah, absolutely, right? And you see it playing out in the markets. We also have a lot of Fed speakers that are weighing in, also reminding us that, you know, the Fed is committed, although it does feel like that Mr. Bullard got a little bit more dovish. I don't know. We kind of parse this a million different ways. You know where I'm going?
No.
I'm gonna look at those.
Don't do it, please.
Come on.
No.
Do
it. Gosh.
You know what? In a year that's already a little confusing, we're not quite sure where things are going. One thing that is very definitive is those Chinese names that trade here in the United States. Don't judge me, world. Bring up the NASDAQ Golden Dragon China Index. It's up another 1.5%. Folks, it is up now 14% this week. Index having its strongest start going all the way back to 2001. I mean, it's up nearly 72% since late October, still down more than 60% from that February 2021 high. And I got to say, you look at technicals like an RSI, it's overbought, it's above its 10-day, its 30-day, and 90-day moving averages, but it continues to head higher. So the Golden Dragon China up 1.7%, Pinduoduo top in the NASDAQ 100, it's up another 5.5%. We know the reasons why, that rollback on COVID zero, more reopenings, more support from the government. I'm just saying that's a pretty decent, strong trade line.
Yeah,
right?
a good start to the year.
Yeah.
I think that's fair to say.
Just gonna say.
I want to go back to the stronger than expected ADP report. And, you know, we can debate to what extent we should read into it, but investors are certainly reading into it in a certain way right now. And that's why we're seeing sectors of interest rate sensitive stocks lower. REITs specifically, I'm looking at real estate. The S&P 500 Super Composite Real Estate Investment Trust Index, it's got 107 names in it. 101 are down right now. The concern here, of course, is that the Fed is going to have to keep raising rates. And since these are so sensitive to interest rates, then, well, investors selling their shares of REITs and real estate stocks too.
Yeah, interesting to see that sell-off today. Of course, one of the few bright spots on the day is energy. When you look at the headline indices, put it all together, you're down basically about 1% on the S&P, the Dow, and the NASDAQ, and the Russell all combined here. Give or take, I guess, a few ticks here or there, but you put it all together, the net effect is we're really not anywhere different than where we were a few days ago.
It's a similar story on the sector level. Like Romaine just said, energy, it's your only bright spot. It's up about 2% right now. Even though oil's given back some of its gains, it's still higher by about 1%. So energy in the green right now. Communication services, it's been fighting all day. Maybe we'll see how it settles. But like Tim said, at the bottom of the pack, it's real estate. That sector is down 2.3%, but 10 sectors lower on the day overall.
We talk about some of the individual movers and some of the individual stories. Amazon shares lower on the day. The company coming out and confirming that it plans to lay off about 18,000 employees, the biggest reduction in its history on a percentage basis, only about 1% of its total workforce, but still another sign of some of the belt tightening that we're seeing, particularly in the world of tech, even outside the world of tech. Helen of Troy shares down 2%. You probably know it more so for the OXO Good Grips, the kitchen stuff that it makes, and Vicks Vapo Rub. That company saying that it plans to actually cut its staff by about 10%. We had Bed Bath & Beyond come out with a going concern statement today, potential layoffs there. Those shares down 24% now, trading at $1.83, and at least one analyst, KeyBank, cutting the price target all the way down to 10 cents a share. And then you had Silvergate Capital down 43%, the banker to the digital world having to lay off about 40% of its staff amid a bunch of withdrawals here. That's the drip, 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 guys, that we've been hearing from all of these companies when it comes to dealing with their own workforce and downsizing, if you will. And then we got the actual official data, strong ADP data growth, but then we got the Challenger jobs cut data, which actually did show one of the largest increases in job cuts that we've seen in a couple of years, basically since the pandemic, so 2020. You look at that chart there, obviously not a whole lot to be scared when you look at the spikes that we saw a few years back, but that is the concern here, is that even while you see maybe a resilient NFP report, resilient ADP reports, resiliency and wage gains, if these job cuts that we're starting to hear from these individual companies continue, eventually that will feed in to the official official data.
Yeah, a couple more, Romaine, on that list today include Compass, Stitch Fix as well. The list continues to go on. We made this point earlier with Mike McKee, and he said, you know, tech companies make up, and look, not all these are tech companies, but they make such a small portion of the overall workforce. We need to start getting concerned when we hear about car companies and auto manufacturers making layoff announcements that would be, you know, 5-10% of their workforce. So still not necessarily a huge concern, but again, it does seem like every single day that drip just continues.
I will say Mike also added some caveats in terms of the weekly jobless and the data that we see in December, that because of the holidays, you have 2 less days, so that can skew some of the reporting, and people are not likely to come forward and file for those claims. And ADP, he said, they did a reconfiguration. So, you know, it's still kind of too early to decide whether or not to kind of trust really the numbers in terms of what they say about the labor market. Having said that,
I trust them.
Do you?
No.
Okay.
Gotta trust someone.
I just like to disagree with Carol. So.
Yes, you do. All right, so let's see what you have to say about this, because the economists are weighing in, certainly about the economy and about the labor market. Seth Carpenter, he is Morgan Stanley's chief global economist. He was earlier on our air, and he said, yeah, we're seeing some strong data points, but get ready for maybe a change. Check it out.
The initial jobless claims data, what we're thinking is going to happen, and this is consistent with the anecdotes from the minutes, is that businesses will try to hoard labor. And so what we're likely to see is slower and slower and slower non-farm payrolls. We'll get tomorrow's data, obviously, where we're looking for about 185,000. But we're looking for a slowing down in hiring. We're not looking for a wave of layoffs. And taking out that territory is going to be, is where we've been.
All right, that's Seth Carpenter. Of course, he's the chief global economist over at Morgan Stanley. We also had, Romaine, Jim Bullard of the Fed weighing in on the labor market and other thoughts of the economy.
Yeah, and actually some headlines crossing the wire right now. He's also been speaking for quite some time and now responding to reporters' questions, saying that he is in favor of front-loading rate hikes. There's still a debate about 25 or 50 at the next meeting, but he does say with a strong job market, it means it's a good time to fight inflation.
Well, and that's what Mike McKee said. He said, watch if we get a strong jobs report. We're going to go back to that debate. Okay, is it 25 or is it 50, Katie, come that first Fed meeting February 1st?
And does it really matter if it's 25 or 50? I feel like all the attention is really on the terminal rate now that we have gotten the downshift, what the signal is at February about how much longer they intend to hike and how long they plan to keep rates at those levels. It's going to be one to watch.
Yeah, no, that's a really good point. I feel like the message from the Fed is pretty clear. All right, guys, we're going to be back in less than an hour's time. Our cross-platform coverage, radio, TV, quick take, and on YouTube. We're going to count you down to the close on this Thursday at 4 p.m. Wall Street time. Wouldn't this be a nice story that we could start talking about in 2023? And that is peace between Russia and Ukraine. Because, surprise, surprise, earlier today, Russian President Vladimir Putin ordered his forces to cease fighting in Ukraine for 36 hours starting tomorrow, Friday, at noon, Moscow time. So, Tim, is it a change of heart, or, as Kyiv quickly dismissed, a ploy by President Putin?
Well, we've got a great voice to address exactly that question. Back with us here on Bloomberg, we've got Angela Stent, Senior Advisor to the Center for Eurasian, Russian, and East European Studies. She also served as National Intelligence Officer for Russia and Eurasia at the National Intelligence Council, and before that served at the U.S. Department of State. Her latest book is on Vladimir Putin. It's called Putin's World, Russia Against the West and with the Rest. She's with us right now on the phone from Washington, D.C. It's really good to have you back with us, Angela. Thanks so much for joining us. So how did you read into that news today? Was it a change of heart, or, as Kyiv quickly dismissed, a ploy by Putin?
Oh, this isn't a change of heart. I mean, Putin was, first of all, deferring to the Russian Orthodox Church. The Patriarch asked him for this ceasefire, so he wants to show that he respects the church, since this Patriarch is an enthusiastic supporter of this war against Ukraine. It was for domestic purposes, to show his people that, he respected the Orthodox Christmas, and I think to the outside world, to make it look as if, well, he is interested, in at least for 36 hours, a ceasefire. But I think it could also be because on Monday there was a major Ukrainian attack on an army barracks in Makivka, where hundreds of Russians apparently died, and the army has been heavily criticized for being partly responsible for this, for allowing the soldiers to have their cell phones working so the Ukrainians knew where they were, etc. And it may be that Putin wanted to avoid any, subsequent attack on Russian troops during Orthodox Christmas. So this is, I think, more or less a ploy. The Ukrainians clearly don't take it seriously, and we really see no signs that Putin's interested in serious negotiation with the Ukrainians.
Angela, I feel like nobody can tell Vladimir Putin what to do. You would know this or understand him certainly more than I would. But, I mean, why would he do this? Does it make sense at all? Even if why do this ploy if that's what it ultimately is?
Well, because it's partly for PR purposes globally to show that he's reasonable, but also, as I said, to kind of show that he supports the Russian Orthodox Church and show his people that he's willing to give them a respite for 36 hours. Now, some Ukrainians think, the Russians are going to use this to regroup. It doesn't really give them that long to regroup, but that's why he did it. And so that, to reinforce those voices in the outside world and the West who say, well, maybe he is serious about negotiation.
Well, that's my question. It's about negotiation, but also about just troop morale as this war, Russia's invasion of Ukraine, enters what could be a very brutal winter, and of course the second year in just a month or so, Angela. So what does it mean for morale right now, and what do we know about morale?
Well, I think morale among the Ukrainian soldiers is pretty high. They're highly motivated. They're fighting for their country. But morale among Russian soldiers isn't so high. I mean, we've had hundreds of thousands, actually, of Russians trying to avoid the last mobilization. There are now rumors that there's going to be a new mobilization coming very soon. And so people, again, are concerned about that. And there are increasingly, Russians who go and fight there, and they don't understand what the point of it is. And why there have been all these casualties. So I do not believe that morale is that high among the Russian soldiers. And, they're not even given the equipment they need. When they're mobilized, they have to provide everything themselves. So it's, it doesn't make them look in a very favorable way on the Russian military.
The other thing we talked about, Angela, today here at Bloomberg is how the U.S. and Germany are specifically sending armored vehicles to Ukraine. President Joe Biden and Chancellor Olaf Scholz saying that in a joint statement. So that's a pretty significant upgrade in firepower that was sought by the Ukrainian president. Germany is also going to follow the U.S. in providing a Patriot missile defense system to Ukraine. I mean, this stuff's getting pretty serious in terms of the types of equipment that goes to the Ukraine. How are you thinking about 2023 in terms of this war?
Well, I mean, the war's certainly going to continue, and the Ukrainians can only continue to push back against the Russians if they have the Western equipment. And I think it's very good that the U.S. and Germany, and by the way, France announced yesterday it too was going to provide, modern Western tanks to Ukraine. So far, the Poles and others, former Warsaw Pact members, have supplied Ukraine with Soviet-era tanks, but now they're going to get the modern Western stuff, and this will help them to keep pushing back against the Russians, because without that, they would be in a much worse situation.
Angela, we've been talking about you, and gratefully, we've really relied on you to weigh in on this. This is somebody you've written about. I'm talking about Vladimir Putin, and you understand. As the longer this goes on, how do you think about the stability of this leader?
So I think at the moment you can say he is still in charge, because he's created a system where there really is no successor that's been named, and there are no kind of opponents that we know of high up in the ranks that could do something about, persuading him to retire. But I think that the longer this war goes on, and the Russian army doesn't do well on the battlefield, I think in the end that does begin to erode his position. So far, there are a lot of critics, the more hawkish critics, but they're blaming the military for all the problems. They're not blaming Putin himself. That could change, and if that were to change, then I think his hold on power might be somewhat weaker. On the other hand, he probably, will remain in power for this year, and he'll run for president again in 2024.
The question comes up, and has really come up over the last few months, as about a potential off-ramp for Vladimir Putin. If the U.S. and the Western world continues to provide Ukraine with this aid, and Ukraine indeed continues to surpass at least the earliest expectations of being able to defend itself and fend off Russia, what is an off-ramp for Putin?
Yeah, does it come via Turkish President Erdogan?
I'm not sure that there is an off-ramp. I mean, Putin, the Russians are still insisting at a minimum that the Ukrainians recognize the annexation of 4 territories, none of which Russia fully controls, and 2 of which, until this war began, were firmly under Ukrainian control. Why would the Ukrainians make those kind of territorial concessions when they're doing better on the battlefield? And it's not clear that Putin would accept any less than this recognition, at least of the annexation of these 4 territories. So I'm not seeing any off-ramp. I know that countries like Turkey are trying to mediate. People have asked the Chinese would they like to mediate, but I don't think any of those countries, and even China, necessarily has the will or really has the power to persuade Putin to do something that he doesn't want to do.
Do you think in terms of, we talked about the equipment, right? U.S., Germany, you mentioned France, the amount of equipment that is going to Ukraine to help it in its fight against Russia. Is the right kind of support being shown in your view? If you were a policy advisor at this point, you understand this world. Is there something else on that policy document that you would be sharing with the President of the United States or other leaders?
Well, I think the Biden administration has done a lot for Ukraine, but it has its own red lines worked out, I think, with its NATO allies, which is not getting into a situation where there might be a direct conflict between NATO troops and Russia. And therefore, if we'd had a no-fly zone at the beginning of this war, the Ukrainians wouldn't have been subject to all these bombardments. That wasn't done because of the concern about that. I think, when this is all over, there will clearly be discussions about, were we all too concerned about escalation? Again, you get the nuclear rhetoric from Putin. How serious is that? Were we all too concerned about that to do what was really needed to help Ukraine push the Russians out of the territories, at least, that they've taken since February 24th. But at the moment, that is the administration's policy, and I don't see that changing.
Hey, Angela, just about a minute left here. What would surprise you here as this continues to go on?
Well, I would be surprised, in fact, if the Russians suddenly said, okay, well, we're willing to sit down and talk to the Ukrainians, but not on the basis that they have to accept all the annexation of the territories. That would surprise me. I would be very pleasantly surprised by that, but I'm not sure that we're going to see that.
All right, going to leave it on that note. Happy New Year, Angela, and thank you so much, as always. Angela Stent, Senior Fellow at the Brookings Institution. She is author of Putin's World, Russia Against the West, and with the rest, joining us on the phone from Washington, D.C. As we mentioned, she served as National Intelligence Officer for Russia and Eurasia at the National Intelligence Council. Before that, she was at the U.S. Department of State. I mean, understands what's going on, in these kinds of situations behind closed doors.
A little concerning that there's still no off-ramp for Putin. So what is this, a stalemate?
I don't know.
I mean, it's stalemate in the sense of this is what keeps happening, right? The fighting just continues.
Well, it certainly feels that way. I think about saving face as a world leader. Like, how do you get out of this? I don't know. I really don't know at this time, but it's something that we know investors, top of the list, those geopolitical concerns as they drag on. All right, you are listening and watching Bloomberg Business Week. Carol Massar, Tim Stanovec. We're back in just a moment right here on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks lower across the board, 38 minutes to go ahead of the closing bell. And this Bloomberg Business Flash is brought to you by Innovation Refunds. Small businesses impacted by the COVID-19 pandemic may qualify for the Employee Retention Credit. Let Innovation Refunds do the work to find out now if your organization qualifies for ERC assistance. They've already helped businesses claim over $2 billion in payroll tax refunds. Learn more at getrefunds.com. Now, let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. equities remain under pressure here with the Dow currently down 311 points. S&P's dropped 41 and NASDAQ is lower by 1.3%. The U.S. 10-year yield at 3.72%. Gold is trading lower by 21. Oil in the green, but Bitcoin is little changed. Among the main 11 S&P sectors, only energy is in the green, and leaders to the upside in the Dow, Chevron, and Verizon, while Walgreens fell 6.6% after earnings and led to the downside. Also after earnings, Constellation Brands fell 9%, and in other news, Silvergate Capital plunged 43%. In the hedge fund space, Citadel posted record revenues for its hedge fund and securities operations. And wrapping things up, Bed Bath & Beyond warned it may need to file for bankruptcy. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg, type SQUAWK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet there. Well, shares of Amazon, as we've been talking about, trading a little bit lower today, down about 1.8% following aftermarket news yesterday. The company slashing more than 18,000 jobs, Amazon's biggest reduction in its history. But, Tim, we keep putting some size and scope in perspective because Amazon employs a lot of people.
Yeah, 1.5 million people to be exact, and about 350,000 of those are those corporate employees. So the majority of the people who work for the company are, of course, those warehouse workers. Let's dig into it, though. And we've got a great voice. Bloomberg News senior executive editor of Global Tech, Brad Stone, is with us. He, of course, is the author of The Everything Store, Jeff Bezos and the Age of Amazon. And also, more recently, Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. Brad joins us via Zoom from our San Francisco bureau. Brad, good to have you with us. You've covered Amazon from the beginning. How should we look into this contextually with Amazon's history of weathering other ups and downs?
Right. Well, yes, Tim. You know, I will go back in history, and I was thinking about the .com bust, and Bezos back then had a mantra, and it was the only way out of this is to invent our way out. And that spirit of invention led to things like AWS and the Kindle, and ultimately Alexa. And I'm thinking about that today, and I feel like Andy Jassy's mantra is a lot less inspirational. It's the only way out of this is to execute our way out. And what I mean by that is if you go back and look at the last quarter.
Sounds like a CEO, Brad.
Yeah, and not like capital punishment execution. It's getting more efficient. You go back to the last quarter in the retail business, you know, you strip out AWS and the retail business lost $3 billion, maybe $2.5 billion, and then you take advertising profit out of that, and it's losing like $9 or $10 billion. And part of that is this perfect storm of post-COVID costs, gasoline, hiring. Prime itself is getting more expensive. They're adding all that video content. And investors are finally kind of fed up with it, and they want Jassy to finally execute, to show profitability in this 25-year-old business that should be much more profitable than it is. And I think this 18,000 person layoffs, it's 1% of the company, is one of those first key steps to him. You know, Jassy's going to have to prove himself, really show his mettle, and right-size this company and get it growing again.
So, Brad, when you know this company so well, as we mentioned, the 2 books you've written, I'm wondering if you're thinking about a 3rd book, but we'll get to that later. No, he's shaking his head. He's shaking his head. No, but I do wonder, like, where is it that most folks, investors, and as you look at this company, where is it that maybe he should be focusing his efforts, that it makes sense that that's the future of the company?
Yeah, I mean, look, AWS is the profit engine. You still can rely on double-digit growth for the near term. There's more competition. We've talked about that a lot, but there's so much backlog in terms of the transition to the cloud and room to grow. So I think, you know, and people know Jassy for AWS, and he's got a history there. Where he has to prove himself to investors is with the retail business. This is, and Bezos left him. Bezos got out at the right time, but the legacy, if you look at it, it's not great. I mean, they overpaid for MGM at a time when everybody is hitting the brakes on streaming. Nobody other than Netflix is profitable. The cost of Prime is going up. The whole intricate machinery isn't fitting together as well as it used to. Demand is slowing. Bezos authorized an overexpansion of fulfillment capacity during the pandemic. Amazon costs are up, demand's down. So Jassy's really got to focus on getting that ship in order, lowering costs and showing that retail can be profitable and putting to rest the fears of investors. Amazon stock has lost about 50% of its value. Actually, I should look, it might be more than that over the last year, and because people just don't quite trust the company again to return to those pre-pandemic or mid-pandemic growth rates.
I just have to say, because we were talking with Max Chafkin earlier, our first story he's got in his remarks in Business Week magazine, Bezos lost a net worth, his net worth dropped, 43% last year, $85 billion. I mean, so, you can take it back to, I think Amazon was down about 50% last year.
Elon would be jealous.
That's true. Okay, Brad.
It's all perspective, right?
I think I remember reading about this in one of your books. There's a framed magazine cover in Jeff Bezos' office, or maybe it's somewhere else. Correct me on the details, but it's a cover of is it Barron's? It says Amazon.bomb.
Yeah.
And it was another time that Amazon lost a large portion of its market cap, and it came back from that. What's the detail there? Right. And it's done this before. It's invented its way out of this.
It's true, but going back to what I was saying, like the mantra might have to change. It might be so in the 90s, Bezos was spending money on everything. He was buying a ton of companies, and after the dot-com bust, he got very frugal. Suddenly they didn't buy a company for almost 10 years, and it was very much minding the knitting. There were sayings inside the fulfillment centers and in the offices in terms of like aphorisms for getting costs out of the company, and they really figured out how to make that company profitable. And then over the last 5 to 8 years of Bezos' tenure, he kind of lost that focus. It might have been part of the midlife crisis, but they started spending again, buying companies, hiring tons of people, opening expansions, fulfillment centers everywhere. And it might be that they need to get back to that spirit of frugality and doing more with less, framing some of those negative articles again and putting them in their halls to prove to the world that they can make this business work.
Okay, Bob Iger came back to Disney.
I was thinking the same thing.
Howard Schultz back to Starbucks for a third time.
Everybody on radio, Brad shaking his head no again.
Brad, it's not going to happen?
Somebody pulled from Where the Sun Doesn't Shine some idea earlier this week that Bezos would return in 2023. And there's no evidence for that. It doesn't even rise to the level of rumor. I would suggest anyone who's interested in this theory to just go check Jeff and Lauren Sanchez's Instagram feed. They are having way too much fun traveling the world, pursuing their philanthropic aims, living large. I don't see that in the cards at all. I would say it's not even worth talking about. What we're going to find out in the next 5 years is what Andy Jassy is made of. Can he run this company? Is he the worthwhile heir that Jeff Bezos thought he was?
Well, and that's what I was going to ask you. And it's funny, I just looked at the holdings function on Bloomberg. I mean, Jeff Bezos holds the most, but it's followed by then obviously a lot of the index fund companies that are out there. I mean, how long does Jassy have to show that he can kind of make it work? And does Amazon have to be worried about an activist or anybody coming in and saying, come on, guys, get it together?
Yeah, that's a good question. I would imagine, I always thought that Amazon was activist proof when Jeff ran it because there was such a halo of invincibility over Bezos's head. And Andy, of course, isn't the founder, but Jeff is still on the board and he's executive chairman. So I don't know if that's in the cards short term, but how long does he have? Going back to my previous point that Bezos himself was the author of Amazon's overexpansion during the pandemic and a lot of the problems that Jassy's trying to solve now, I still think he has a couple of years. I would give him 3 to 5 years to fully put his imprint on the company. I think in the next year, we're going to see more visibility from Amazon in how they report the health of the retail business, more clarity to investors, maybe some things investors are asking for to forestall a kind of investor uprising, and ultimately him trying to move Amazon to core profitability in the retail business, improve some of the fundamentals, and restore the stock price to growth.
Does that mean there's no more delivery robots or what? Like none of that fun stuff?
No. I mean, they have cut some of the excesses, the experiment, but Zoox and autonomy is still a major investment area. When there were reports that they were cutting to the bone on Alexa, Amazon put Dave Limp, the head of the department, on the phone with Matt Day and I, my colleague here at Bloomberg, to reassure us that Alexa is still an avenue for growth. I don't think they'll stop experimenting. Healthcare is a big initiative for Andy Jassy, but I really do think that he will be measured and judged by, how well he could turn around the health of the retail business.
That's why we go to you, Brad Stone. Man, we love it. And just your access and understanding of this company. Brad, thank you so much. Happy New Year. Brad, of course, Bloomberg News Senior Executive Editor of Global Technology, author of, you should read his books if you haven't, The Everything Store, Jeff Bezos and the Age of Amazon, and then Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. Brad joining us via Zoom from the San Francisco Bureau.
I guess I should follow them on Instagram. Bezos and Sanchez.
Is that why you get so pumped up,
I
Jeff
guess,
Bezos?
maybe. Let's get to Washington, D.C. for a check on the latest world and national news. Nancy Lyons is in our 991 newsroom. Hey, Nance.
Thanks, Tim. Pressure is building on Kevin McCarthy to determine whether or not he can win over fellow Republicans to become House Speaker. He's already lost 2 more votes today, with at least another to come. Democratic Congressman Brendan Boyle of Pennsylvania tells Bloomberg McCarthy faces strong opposition from some of his colleagues.
He is someone who, frankly, stands for nothing, and enough of his members know that. He has morphed ever since 2015, especially, into attempting to be this shape-shifting, ultra-MAGA guy, when really enough of his members know that, frankly, the only principle he stands for is advancing Kevin McCarthy.
Again, Democratic Congressman Brendan Boyle. President Biden says he plans to travel to the heart of the current surge of illegal immigration.
I will visit the border myself this Sunday in El Paso to assess border enforcement operations.
Biden says he wants to hear from leaders in El Paso about what they need to handle the flow of migration. It'll be Biden's first stop at the southern border since taking office. Newly released court documents reveal some of the evidence that authorities have collected in the murders of 4 University of Idaho students. The suspect, Brian Koberger, visited the area near the home about a dozen times since June. That's according to cell phone data. And his DNA was allegedly found on a knife sheath left at the scene. Doctors in Cincinnati say Buffalo Bills safety Damar Hamlin is showing substantial improvement after suffering cardiac arrest on the field in Monday night's game. He cannot speak yet, but when he woke up, he wrote his first question, which was, "Who won the game?" Doctors told him he won the game of life. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.